you at least want to keep an eye on the labor market. That's really the only point of concern.
I think right now it's actually the unemployment rate that's probably the single biggest data point we're going to get.
I don't think things are as calm in the labor market as the Fed kind of in their latest projection seems to view it.
This is a moderating labor market. It's cooling, it's softening.
If NFP is strong, then the Fed's cuts really come out of the table. Or if it's a really weak number, equities are probably going to look up and say, hey, maybe the economy is not as strong as we thought it was.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Friday, facing down a week of losses with equity futures on the S&P 500 negative by 0.2%. On the Nasdaq, also down by 0.2. Going into the first big data point of 2025, the payrolls report just around the corner. The median estimate in our survey, 165. The low, 100. Lisa, the high, 268.
And it comes at a time where it's unclear exactly how to read this data. What is the threshold for the Fed to actually cut rates again? Right now, people are saying that threshold is incredibly high at a time where we still see robust job growth. At the same time, it's slowing. The bigger question to me is, what is the threshold for this bond market to rally big time and for people to retrace some of their inflationary concerns over the past month?
This is part one. Part two is next week. CPI is just around the corner, and we've sensed the discomfort on the FOMC with the inflation story over the past week or so. Bowman, Cook, Kugler, Daly, all signaling some discomfort with the inflation story.
Coming out and basically saying, and this I thought was really interesting, Kansas City Fed President Schmidt saying that rates already might be very close to neutral, really reassessing just how much they are done with the recalibration and going toward that careful assessment. We had Alberto Musalem coming out and basically saying that the Fed has to be much more gradual even than he thought back in, guess when? Oh, yeah, that's right, September.
Yes. Only a few months ago, and we've seen the bond market move 100 basis points since then on a 10-year yield, so the bond market's doing a lot of work for them. Once you get past CPI on the 15th, then it's on to Inauguration Day. And based on our reporting, Lisa, and we'll catch up with Anne-Marie down in Washington later on this story, based on our reporting on day one, the president's ready to go.
He's got a lot of executive orders that have to do with immigration, that have to do with the budget, that have to do with tax cuts. And he's going to be putting everything out there. Key question for a lot of people is what actually sticks? What can he actually get through when he starts talking about deporting criminals, when he starts talking about tightening the border, given the fact that some of this takes money. But at the same time, this is where the volatility comes into play and the reason why people say sometimes the year starts then.
If you are just joining us, welcome to the programme. Wait for the 20th, 10 days away, and that's when the year truly begins, to Lisa's point. Equity futures on the S&P, negative by 0.2%. Joining us this hour, we'll be catching up with Chris Verrone of Strategas with rates at a so-called red line for risk. Ed Mills of Raymond James with TikTok's future in the hands of the Supreme Court. And Sarah House of Wells Fargo seeing moderation in the labour market. We begin this hour with stocks falling as traders await US payrolls at 8:30 Eastern Time. Chris Verrone of Strategas, a bad company, focused on the bond market and writing rates are at a red line for risk. 10-year yields remain in the uncomfortable zone, above 4.5%, and intent on challenging the key 475 level from last April. Equities didn't like it then and don't seem too keen about it today. Chris joins us now for more. Chris, good morning. It's good to see you.
Great to be here.
Happy New Year, sir. These moves in the bond market, we've asked this question a few times already to start 25. Given the fact that you believe we're at that uncomfortable level, the danger zone, according to HSBC, are we at that point where this move becomes self-limiting?
Well, it's not that I believe we're in the danger zone. Just look at what the home builders have done here. Look what the REITs have done here. I think the market is telling you you're at some level here where you're really pushing your luck on at what level do 10-year yield or do rates really begin to hit the economy. I think that's the question. It doesn't matter if it's 475 or 502 or 513, right? Where are we in this conversation of at what level do rates really start to have a meaningful effect on the economy over the next 6 or 12 months?
And is this the new normal? And can we handle interest rates at these kind of levels? Do you think we can?
Well, I think the key for that question is how can cyclicality fare with rates in this ballpark? And that's the one thing. Put home builders aside for a moment. On balance, cyclicals have generally held their own here. I think financials in particular are really key. I mean, they haven't been as weak to the same potion this time around as they were in, say, March or April of 2023 when higher rates really hurt the bank. So I think that's going to be a very key tell. Credit conditions have actually been remarkably benign through a lot of this here also. Now, again, that can change quickly. Credit can move like a heart attack. But we're at this kind of fine moment here where I don't think we want to push our luck on yields much higher from here.
That said, if, let's say, yields go much lower on the heels of today's labor market report because it's disappointing, is that good or bad for stocks?
Well, this is the tricky part of the call here. I've never been sympathetic to the view of hoping for weak data or rooting for weak data. It typically means if you're hoping in this business, you're on the wrong side of the tape, right? So I think we've got to be careful. My best guess is we want an inline or even a decently strong number to validate what bond yields have done. I think the worst combination is bond yields up with weakening data, is which, ironically, what you've had a little bit since the December Fed meeting, right? You've had some softer data as bond yields have gone up. That's an unattractive combination. So I think you want the data to validate what bond yields have done. I think you want cyclicality to validate what bond yields have done. I get very uncomfortable when cyclicals are weakening and rates are going up. That was second half 2018, and we remember what happened in October, November, December of that year.
This goes really to the heart of a question that Stuart Kaiser of Citigroup raised, which is, are we in 2017 of Trump's administration or 2018? And it really comes to the sequencing of the incoming policies, et cetera. I'm glad that John brought up the day one policies, and we're getting a little bit of a hint of them with respect to immigration, but also cuts across the government. And that has been one of the mainstays, frankly, of the hiring that we have seen in this labor market. How are you evolving your thinking around the policies and whether they're bullish or bearish right now for the overall risk appetite?
Well, if you go back to the 2016, 17, 2018 cadence, what I think people forget is as the tax cuts were being debated in 17, it was a very pro-risk, pro-cyclical moment. It was the passing of the tax cuts that actually kind of put the top in cyclicality, right? If you remember, early 18 is when cyclicals began to kind of lose their oomph. You had rates going up, you had cyclicals weakening, undesirable combination. So it almost seems like we've kind of skipped 2017 here, and we're kind of right in this 2018 moment where higher bond yields have kind of disrupted some of the cyclical momentum that this market and the economy have. So I think that's the fine line, Lisa. We don't want to lose cyclicals here. We don't want to lose credit here. And to what extent does the new administration almost facilitate these things?
Have we lost the rest of the world? Because I remember the global synchronized growth story back then as well. It's a very different story now. What do you make of things at the moment?
Yeah, it's certainly bifurcated. I mean, one thing I'm struggling to reconcile is why there's actually some parts of Europe that actually seem to be firming here a little bit. European luxury comes to mind. I'm surprised by this, but I'll take the market's opinion over my own. The fact that LVMH seems to be getting better here.
The DAX through the whole of last year.
Hermes broke out this week. Richemont has turned. This may just be responding to weaker currency, but nevertheless, there are some modest improvements there. Where we're getting more and more bearish on is actually India. And I think this is interesting with the respect that there's a very consensus view out there that if Trump were to win or if Trump won, it would be extremely bullish for India. Well, to what extent was that priced in for the last several years? I mean, the Indian markets are rolling over meaningfully in our work. They've deteriorated in our trend work. And yet, I think the consensus is still very comfortable in being long there. We are not. I think that part of the world has weakened.
Let's stay over in Asia, in that part of the world, and move over to China. It's a complete opposite story in China compared to the United States, where yields have been lower. There's been a big question about whether the government is spending enough. Any signs of stabilization there whatsoever?
I think you need a clearing moment in currency. And, that's one of the big lessons. We were talking about 92 earlier off air about a central bank or a country being pushed to the brink where there's only one option that's left. I think the only option left here is to devalue the currency. 737s being the big level on dollar CNH. I suspect we'll lose that here. 780 would be the level I would focus on. We've seen the move in the rates. It's been extraordinary. I think there's a clearing moment to come in global FX that will be dominated by this move in dollar CNH. I think that's the prerequisite for growth ultimately bottoming and turning in that part of the world.
Is it something that really is focused on China, or are you talking about a clearing event with dollar strength that could also maybe clear out some of the bearishness around Europe as well?
Yeah, I think if you wanted to hypothetically lay out the case of what could turn rest of world or turn Europe or turn emerging Asia in, say, second half 25, it's a clearing event in global currencies in first half 25, which I think we're in the middle of. I mean, look at Aussie's back to basically where it was at the COVID lows, not too far away from where it was at the 02 203 lows. We talked about sterling before. 123 today seems too high. I mean, 105 to 110 seems more appropriate. We've seen euro. Is this the event that has to happen to kind of reset the playing field here and put rest of world in a position to outperform? I know it's been very fashionable for the sell side to, every year say, oh, this is the year that rest of world outperforms. I don't think that can happen until this clearing moment in FX is upon us. That might be here.
This is actually a fascinating point at a time where some people are looking at that level of the dollar's strength that becomes a breaking point. It also is interesting at a time where people are saying that actually a strong dollar could impede some of the earnings for U.S. companies at a time where that needs to hang in there for this American exceptionalism story to continue. How far away are we from that moment?
I think the irony about American I think maybe the irony here of the America First policy is it's creating change in other parts of the world. I mean, look at Canada, look at Germany, look at UK, right? That to me is the irony here, which does that set the stage for a robust maybe second half in parts of this world. With respect to dollar, we did some work just last week. The 3-month rate of change in DXY is in the 95th percentile right now historically. You have not seen great forward S&P returns over the next 6 and 12 months from that condition. So I want to be mindful of that. I also just want to be aware, everyone I know is a dollar bull. And if you look at any of our sentiment work, it is really kind of pushed to the extreme here, particularly on CAD, particularly on euro. So I think if you got some flush here, that would be my signal to cover dollar shorts or cover dollar longs and maybe think about the other side of the story.
You've got to recognize how quickly this position was built up as well. We came out the summer and everyone was bearish the US dollar. Yeah. Do you remember some of those calls?
I do. I also remember what happened after the Fed cut by 50 basis points. And I think that move really highlighted the shift where, wait a second, not so fast. Because maybe this wasn't the right call.
On course for a 6th consecutive week of dollar strength. Chris, it's good to see you, sir.
Great to be here.
Appreciate your time. Thank you. Chris Verrone there of Strategas, a bad company. Just some breaking news for you. It's coming from CNN that Chinese hackers breached CFIUS back in December. Stunning reporting, although for many of you not surprising. Chinese hackers breaching the US government office that reviews foreign investments for national security risks, according to 3 US officials familiar with the matter.
The concerning thing is this just builds on all the other hacks that we have heard about that are becoming increasingly exposed. And there isn't a clear message on how they are being prevented going forward at a time where some basic systems have been breached with some basic infrastructure that have been put in place years and years ago.
We'll head down to Washington, D.C. in just a moment. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. President Joe Biden has increased federal assistance to California to combat the wildfires, urging Governor Gavin Newsom to spare no expense.
So today I'm announcing that the federal government will cover 100% of the cost for 180 days. This is going to pay for things like debris and hazard material removal, temporary shelters, first responders' salaries, and all necessary measures to protect life and property.
The president also announced 400 additional federal firefighters and over 30 firefighting helicopters and planes to support California. The Department of Defense has also authorized 500 wildfire ground clearing personnel. TSMC shares are rising in the pre-market 1 1/3%. The chipmaker reported quarterly sales that topped estimates. Revenue growth accelerated in December thanks to its key role as a supplier to tech giants like Nvidia and Apple. Shares as a whole have risen nearly 90% over the past 12 months, with market value also doubling in that time period. TSMC will report its full earnings next Thursday. Sources tell us that executives at top investment banks plan to reward traders and deal makers with their largest bonus increases since the pandemic. 10% hikes or more are expected from many firms like Bank of America, Morgan Stanley, JP Morgan. Sources say that increases might be even higher at Goldman Sachs. The bumps, as always, are helped to retain talent, but also reflect business optimism for the year ahead. That's your brief. John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the program, warming up to TikTok.
We'll either close up TikTok in this country for security reasons, or it'll be sold. We did go on TikTok, and we had a great response with billions of views. They said, maybe we got to keep this sucker around a little while.
It's a big change from the incoming president. We'll discuss that next down in Washington from New York City this morning on this Payrolls Friday. Good morning. Equity futures on the S&P negative here by close to 0.1%. Check out the bond market. Yields higher by almost a basis point. We've gone almost 6 sessions now without a single day of declining yields, pushing 470 once again on a 10-year. And a surveillance this morning, warming up to TikTok.
We'll either close up TikTok in this country for security reasons, or it'll be sold.
I have a warm spot in my heart for TikTok because I won youth by 34 points. And there are those that say that TikTok has something to do with that.
We did go on TikTok, and we had a great response with billions of views. They said, maybe we got to keep this sucker around a little while.
So here's the latest this morning. The Supreme Court hearing arguments today over a bipartisan law that would ban TikTok in the United States. Its Chinese parent company ByteDance facing a ban January 19th if it doesn't divest, the day before Trump's inauguration. Anne-Marie joins us now from Washington with Ed Mills of Raymond James. Anne-Marie, over to you.
Good morning, Jonathan. The clock is literally ticking for TikTok, and today they're going to have their day at the Supreme Court to try to combat this bill. And they will either be banned unless they divest away from ByteDance, this Chinese company. What do you think happens, Ed?
I think on January 19th, TikTok ceases to exist here in the United States. I think the wild card here is that under the law, the President of the United States has an ability to extend one time for 90 days. So the question that I have is, come January 20th, the next day, does Trump activate that 90-day extension, and is there a deal worked out?
It sounds like he's going to, because he's flip-flopped since his first time in office, in the Oval Office, when he talked about the security concerns of TikTok, that now he thinks actually, in an interview with my colleagues over the summer, talked about the fact that, well, if you don't have TikTok, then Meta's too big, and he understands a lot of individuals get their news from there. It seems like he wants to keep it around. So what are the options, even if there's an extension?
So after the 90 days, one of the things we went through the statute at Raymond James yesterday, published a report about this, and ultimately, it is up to the president to declare that what has happened with the divestment or for foreign ownership has met the needs of the law. And so as long as the president declares, it's okay. The problem for Trump, though, is that if there is not a divestment, a $5,000 per user fee gets kicked in. And I don't think the app stores at Apple or Google or Oracle's hosting of this wants to exist, because when you look at the number of users, I add that up to about an $85 billion fine. And unless you change the law or you have this divested, it will cease to exist, assuming it is upheld by the Supreme Court.
Who can buy this? This isn't even like Elon Musk buying Twitter. This is an incredibly expensive company.
Yeah, I assume the money would be there. The bigger question for me is, will the Chinese government allow it to be sold? Because ultimately,
well,
if you
said no.
Yeah, because you could open up the hood, you look in, and everything that the national security folks have said about keystroke capture, about geolocation, about the algorithm potentially manipulating the users of TikTok, all of that will be very apparent. And we will know even more of how the Chinese have been spying on Americans using a very popular app.
Trump will also be breaking with his national security advisor and his secretary of state.
And? I mean, it's just like Trump will break with his administration whenever he wants. I do think it's important that you highlight the kind of animus that he's had towards Meta and towards the potential benefit to Instagram because of this. It does look like some of that animus might be reduced over the actions by Meta, by Mark Zuckerberg in recent weeks, trying to get him okay.
Do the concerns grow on a day like today when CNN comes out and says that Chinese hackers breached CFIUS in December? Not really a surprise, as Jonathan said, because we do know that there was Chinese hackers breaching the Treasury Department. But doesn't this become even more of a national security concern? And what's going to be the response from Trump 2.0 to Beijing?
Yeah, I mean, I think it is a extraordinary act that, we knew that there were Chinese hackers that accessed Treasury. It was downplayed by Janet Yellen recently. But for them to have hacked into CFIUS, the Committee on Foreign Investment into the United States, there was a deal that was pending, Nippon Steel trying to buy U.S. Steel. We were looking at all of the potential national security concerns about that, Nippon's operations within China. For them to be looking for exactly what was happening at CFIUS at that time, is a huge concern. And that's why I've always said almost everything in D.C. related to China is bipartisan. The only place you don't want to be is being seen on being on China's side.
Well, except for potentially one. We are waiting for a Commerce Department to come out, and this was a Bloomberg scoop, but I know you've been writing about it for months, about AI chips from NVIDIA. And all roads really lead to China when it comes to wanting to make those export controls tougher, correct?
Yeah, so as early as today, and it's going to happen between now and January 20th, there's going to be a final export control rule that comes out from the Biden administration. This is going to be focused on the number of AI chips that are going to countries that we have concerns about. Now, we've blocked almost everything going to China or to Russia. We're going to allow everything to continue to go to our closest allies, but there's going to be a tier 2 company or country list where we're going to put caps on how much can the Middle East get, how much can Southeast Asia receive. Now, generally speaking, I would have expected this to be bipartisan, but you have Ted Cruz tweeting out last night, strong opposition. You have NVIDIA coming out with strong opposition. So the question I have is...
Because they're going to allies or because the time?
No, because they're going to restrict it going into some Southeast Asian and Middle Eastern countries. The real issue here is almost all of our export controls usually deals with the physical location, but when you're developing data centers and you can access that via the cloud, it might not matter if that AI chip can't go into China if you build that data center in Malaysia or you build that data center in the UAE. If they have that cloud access to it, they've essentially have that technology. So the chips are going to be limited, and there's going to be new rules related to data centers to make sure that they are certified and verified that they're not giving this technology to China.
So if you have Republicans already coming out and saying, we don't want to see this happen, Biden administration is doing it on literally their final days in office, does Trump reverse it?
I think it's going to be hard for him to reverse. What they're going to do is it's an interim final rule. DC speak to it goes into effect immediately, but there's an opportunity for the Trump administration to put the final tweaks on that. If the caps are too low, look for foreign governments to be very transactional. I think Saudi Arabia will put a lot of pressure that if their cap is too low, other Gulf countries, other kind of parts of the tariff conversation, this could be a tit for tat. Hey, I'm willing to do X, Y, and Z to avoid tariffs, including trying to remove these AI caps. Is actually going to give Trump a new tool in his negotiations globally in terms of what does the U.S. have that these other countries want.
I just want to finally end on this point, because you're talking to everyone on the Hill about the process of how his agenda gets accomplished. The bond market, though, is focused on the price. What do you think we're going to see in terms of how big this bill is going to be?
Yeah, so I put the over-under as it relates to both an extension of the tax cuts and if we do an immigration, energy, defense bill at $1.9 trillion. Why do I do that? Because that was the cost of the American Rescue Plan. I don't see Republicans doing a bill bigger than Build Back Better for Biden. And so I do think that we're on the under of that.
But extending the tax cuts is
so
more than
10 years
trillion.
of the tax cuts is $4.6 trillion. 4 or 5 years of the tax cuts is about $1.5 trillion. What would you do? I probably see it goes to 4 or 5 years. The original was 8. You say, hey, we did about half as good in trying to get those other things. People have been too focused on the 10-year extension. I think it ends with a much shorter extension.
Ed Mills, thank you so much for joining me in the studio this morning from D.C. Jonathan, long list of issues that the incoming Trump administration is going to deal with. TikTok, export controls, and, of course, trying to get this agenda through, which Ed Mills says could be under $2 trillion.
AMH, appreciate your time. Thank you. Everybody trying to game this out. We're 10 days away, and then we'll start to get policy almost immediately, and then we can talk about the consequences.
There is this feeling, or at least this outward message from the Trump administration, that the first 100 days is a fiction, and yet what we're seeing is that maybe it's not such a fiction, and they're actually going to be doing quite a lot in those first days, with executive orders in particular.
Preparing to hit the ground running down in Washington, D.C. Up next on the programme, we'll catch up with Jordan Rochester of Mizuho on the UK bond market sell-off. That conversation is coming up next. Equities here down 0.1%, negative on the week as well, heading towards a week of losses, a mild week of losses, but that can all change in 2 hours' time when we get the payrolls report. Equity futures on the Nasdaq were down by also about 0.1%. Let's switch on the board and get to the bond market. A sixth session now without declining yields on a 10-year, up by a single basis point. The 10-year 4.6977. Heard from a range of Fed officials over the past week or so. We talked about a few of them. Bowman, Cook, Kugler, Daly, all signaling some discomfort with inflation at the moment. The outlier is Governor Waller. And Governor Waller just becomes more and more of an outlier for me the more you hear from other Fed officials who are uncomfortable with inflation. Some are concerned about the incoming policy changes from the incoming administration. And there stands Governor Waller, who's not worried about tariffs, doesn't think they're inflationary, and thinks we're on course for more interest rate cuts. This is the reason why people were wondering, okay, is he trying to line up behind the idea of maybe in 2026 being Fed chair? It goes to this point of, A, who are the people who are taking into account some of the policies that are incoming? And B, just how inflationary or not are they going to be? There was someone else, I'm thinking of Patrick Harker of the Philadelphia Fed, also who came out and said, I still see us on a downward policy rate path. So it's a matter of how they message that, perhaps. Is he auditioning as well? I doubt that. To be the next Fed chair, maybe. Delta Airlines, numbers just crossing, kicking off earnings season for the fourth quarter. Passenger revenue coming in at $12.82 billion. The estimate was $12.62. As for the outlook for the first quarter, a range here of 70 cents to $1. The estimate, Lisa, 76. The stock is higher by 1.8%. Yeah, and this coming from Ed Bastian. The supply-demand balance is as good as I can ever recall it being as we look into 2025. We have pretty good visibility through the first quarter and into the spring. Now, pair this with some of the commentary that we've heard out of domestic-focused airlines. Delta has done really well with business travel, with overseas travel at a time where people are trying to take advantage of the strong dollar. And we hear about all the European and Asian adventures that people are going on. And you just have to wonder how much the gains are consolidated in the big airlines that really can take advantage of that more than others. As for that supply-demand balance, let's put that in English and strip out the McKinsey. We cut a load of capacity and demand is good so we can charge higher fares, right? I think. That's what Sheila Kahyaoglu was talking about. Basically, because Boeing hasn't been able to deliver the planes and there's been such robust demand for Airbus planes as well, you basically end up in a situation where de facto they can charge. They have the luxury of charging more and just not having any competition on that front. That is expected to change just slightly through the second half of this year. But yeah, that's probably a good way to put it. How packed is the Delta Airlines lounge these days? How packed is it? I don't know. Have they fixed that at JFK yet? I don't know. I wouldn't know because I haven't been in a Delta lounge in a long time because I am much focused on work. Much humbler and, you know, driving. You're not using the lounge? Okay. I don't have access anymore. Delta in the pre-market. Fix that, Ed Bastian. Delta right now by about 0.1%. Under surveillance this morning, firefighters making some progress on controlling wildfires across Los Angeles. The Kenneth fire now 35% contained and the Pacific Palisades blaze showing early signs of control. AP reporting the death toll, Lisa, has climbed to 10. It is a huge tragedy that's been unfolding. A lot of people starting to put into raw numbers what type of damage this is going to incur financially. Some potential estimates from Accuweather talking about $135 to $150 billion of damage. JP Morgan saying insurers might be on the hook for $20 billion. It really goes to the heart of a question, who is going to pay for this? At a time where so many insurance companies had bowed out of the state because they were not allowed to raise their premia enough to compensate for the potential risk. A significant part of these homes that have been destroyed were not insured at all and lost their insurance or dropped their insurance in the past year or two. You can already see the backlash against local authorities already brewing. I don't think they can hide behind this idea of climate change on this particular issue. Competency is going to be front and centre for the mayor, for Governor Newsom, for all of them. What went wrong here? Why were they so slow to respond? Why didn't they have the things they needed to really do something about this? I think that your point is a good one. And when you zoom out, there's going to be a larger discussion of how do you come up with realistic plans to counter what some people are calling natural disasters that are happening all over because there are changes in the weather patterns, whatever you want to ascribe them to. How do you come up with competent plans
to mitigate some of the damage and mitigate the loss of life, mitigate the ability for people to actually exit in an orderly fashion. And that's going to be true in a number of areas that are disaster prone where you have not had updated maps in a very long time.
Shocking pictures, absolutely shocking. Our thoughts are with the people of Los Angeles and beyond. And of course, we'll bring you updates throughout this morning. Let's turn to our next story. Nvidia slamming new export restrictions that the Biden administration is expected to announce soon, saying the White House is trying to undercut the incoming Trump administration by imposing last-minute rules. The changes would cap the sale of US AI chips on both a country and company basis.
My favorite part of some of the statements that are coming out of the policy representative from NVIDIA are basically trying to shame President Biden into reversing this, saying this isn't going to look good for your legacy, essentially, because this does hamper the ability for the United States to actually be the dominant technology around the world. And all this is going to do is increase some of the competition from others. The issue here is who are our friends? And we talked about this yesterday, increasingly at a time where this is the dominant technology. And this ban would potentially really eliminate the U.S.'s ability or NVIDIA's ability to be in basic data centers around the world.
It's kind of amazing to see one of the biggest companies on the planet making the argument for the Republicans that the outgoing president is looking to undercut the incoming president in his last few weeks.
We've seen a lot of unusual things. And, you know, some people would argue this is trying to cater to the Trump presidency. Some people would argue maybe this is trying to say to Biden, really? Is this
Lisa,
really
I'd go one step further. Who's making this push inside the administration? There's a real question about the cognitive ability of the sitting president right now in this country. People are speaking about it openly. Who's making the push on these policy fronts? Are we really saying that President Biden is sitting there saying, I want to do this, this and this? Or are a lot of people around him trying to squeeze things through on the way out the door and looking for him just to sign it off?
I don't have any insight in this. I will say on a larger point, there is a concern, especially at a time where you have these breaches, these hackers getting into U.S. technology, and it is a bipartisan concern. How you approach this is going to be very important at a time where you have U.S. tech that's dominating, that also is looking to expand overseas, and it is a very difficult needle to thread.
President-elect Donald Trump is going to be busy. He's preparing to issue a host of executive orders immediately after his inauguration. Sources telling Bloomberg the plans centre around immigration, energy, federal workers and regulatory reform, including tighter restrictions on border crossings and putting the mechanics in place to carry out mass deportations.
The issue that I have about all of this is some of it's going to require quite a bit of money, in particular the mass deportations. I'm also curious, especially on Jobs Day, and we have to keep coming back to that. We are in Payrolls Day. The idea that they're looking to shrink the federal workforce. If you take a look at some of the major drivers of the labor market growth, it has been the labor market. That has been it has been the government workforce. That has been one of the pillars of the U.S. labor market. So when you take a look at some of these effects, you have to wonder what that does economically in ways that maybe we're not accounting for.
It is Payrolls Friday. Thanks for the reminder. The UK doesn't need one. The UK will also be focused on the jobs number in the United States. Traders struggling to regain confidence in the market. Gilts continuing to fall after 10-year yields hit their highest level since 2008. Jordan Rochester of Mizuho writing, in the past, these EM-like moments don't last for too long, as the headlines push UK policymakers to correct course, something that will be harder this time, as a lot of the sell-off has been driven by US and European factors. Jordan joins us now for more. Jordan, welcome to the programme, buddy. It's good to see you as always. I think you framed it quite nicely. Internal factors, forces, and external factors. What are the biggest problems right now? Do they come from abroad or within the United Kingdom?
Within the United Kingdom, John, the problem is the mood music around the tax hike of national insurance for employers. And that came from the budget in October, and that's going to pretty much slam employment intentions, which is what we're seeing in the surveys. It's a bit of an eaten mess when it comes to the impact of that budget, because it was supposed to be growth boosting. But if you see employers with this, one of the record tax raising measures, one of the biggest tax raising measures in UK history, £22 billion alone from that national insurance tax hike, which is what you charge on employer contributions of someone's salary. It's going to lead to slower employment growth and lower growth and lower wages in the long term. It's typically a dovish reason, John. It usually leads to gilts rallying, but because of the external factors, it's put the UK in a really painful place. You've got natural gas rising, boosting short-term CPI forecasts. Natural gas has come off the ball a bit in the past few days, but oil's made up for it. So now oil's breaking higher, John. It's really hard for us to be dovish on the CPI prints for January. We're going to see some pretty strong numbers out of Europe and the UK. The UK CPI could be on a 3% handle, and that's the problem. It's external factors that are driving the markets to price out Bank of England rate hikes, which puts the Chancellor in a really painful position because the interest costs are now ballooning to a level where it breaks her new fiscal rules already, just a few months in. What she needs to see, hopefully, John, is those external factors go in the opposite way. So hopefully we see the sell-off in US rates that we've seen. Hopefully that calms down. I don't think it will. Or we've seen energy prices turn over. The macro points to a dovish UK and actually for a reason to buy duration in Europe because the growth leads to recession. But the external factors, the US bouncing back, makes it really hard to put the trade on.
Jordan, to borrow Lisa's phrase, it's a toxic mix, a toxic brew, that's for sure. When you see yields up and the currency weaken, a lot of people are thinking about 2022. There are some differences. What do you think is the key difference between now and 22?
There's a few, and the one that is the most useful for the Chancellor is the Bank of England is in a cutting cycle. And so last time around in 2022, they were in a hiking cycle. It was really difficult for the Bank of England to respond dovishly to the gilt sell-off in 2022. They did a QE program to fix the problems for the LDI community in the long end of the curve in the 30-year. This time round, they don't need to do those operations again. They can just simply cut rates to sort of help the momentum and to remind markets they are in a cutting cycle. So what we've seen priced out, which has led to this sell-off in UK rates, could be put back in, especially for what's priced for February. I think February is a done deal, John. They're going to cut rates in February. Quarterly is the pace that they're on, and the data suggests they should from a growth perspective.
Jordan, we were speaking with Chris Verrone earlier in the show of Strategas, and he was saying we're getting closer and closer to some sort of reckoning, some sort of breaking point on the heels of a stronger dollar, especially in light of what's going on in places like the UK with sterling, like China with the renminbi. Do you agree with that? Is that kind of what you're seeing right now, especially as you see policymakers really kind of forced to accommodate some of the pressure?
I agree, Lisa. There's going to be a breaking point at some stage because Donald Trump's policy mix with tariffs is not exactly good for global growth. So what's happening in equities with the range-bound price action we've had reflects this uncertainty. You've got the business deregulation, you've got the tax cuts, that boosted equity sentiment after the election. But when it comes to tariffs, it is a big negative for global earnings for multinational firms. So I think when we get to Jan 20th, John listed a few of the day one sort of plans that they have already. I noticed tariffs weren't in there. So if tariffs don't make the list, Lisa, then we actually could see risk do pretty well. And we could see some of that dollar strength come off the board as well. But I think we will get tariffs announced in some sort of way on day one, or at least in the first week, at least launching the investigations, because the investigations can last 30 to 60 days for these Section 232, 301, whichever part of the acts they want to work with. So if we're lacking tariffs in the plans, risk as well. But if he goes for it, which I think he will, that could be the moment when equities and risk sentiment really takes a steep dive.
You and John were talking about the differences between the Liz Truss moment of 2022, which she would like to recharacterize, as we've heard in a number of different interviews. There is a question, though, about whether Rachel Reeves, Keir Starmer, or whether some of the leadership in the UK will survive this period of disgruntlement that we're seeing in markets. What's your sense of how it would be received if there was some change in leadership in equity, in the currency markets, in the bond markets?
Indeed. Well, I think I kept the list quite short, actually, in response to John on that, because there's actually loads of differences. And another difference on the politics side is you haven't had Rachel Reeves arrive at the Treasury, tell the OBR, I don't want you to do any forecasts, please don't do them, and then let go one of the chief secretaries to the Treasury. So that was what Liz Truss did, and that led to huge uncertainty, and it therefore required the markets, but also the politicians themselves to call for the end of that leadership. This time round, it's not exactly self-inflicted. As I mentioned, those global factors are driving the latest breach in the fiscal rules. And it's really difficult for a replacement of leadership in the Labour Party. It's got different rules for its leadership than the Tories. The Tories can get rid of their leaders quite easily via votes of no confidence, via letters to the 1922 committee. Labour doesn't really have the same sort of function. Look how long Jeremy Corbyn stayed in the post, for example. And then, of course, it's not self-inflicted, so it's not really their fault that US rates are selling off, natural gas and oil prices are going up. It's a different story. I think they hang on, and I think by March, they're hoping for the best. They're hoping that US labor data slows down. They're hoping that global rates rally, and this natural gas story gets better. But it's a big hope, and hope is not a strategy.
Jordan, I've got to jump in because we don't know what the counterfactual is, but I think it's worth debating. Are you saying that if the Chancellor hadn't come into this job and hadn't gone around saying there was a massive black hole and didn't give away billions of sterling to public sector workers to give them a pay increase and to bring back the old mood music of tax and spend, big tax and spend in the UK, if they had done something different, are you saying it wouldn't have made a difference?
It would have made a difference to the mood music. So I think the drop we've seen of business confidence, John, wouldn't have been as severe, and especially the employment intentions that we're seeing after the national tax hike. But look at Europe, they're selling off as well. It's a global rate story, John, not just the UK. But the UK has a wall of issuance coming due, so does Europe, and it's got a higher beta to whatever US Treasuries do. So it always looks like the ugly duckling.
Jordan, before you run, I wanted to squeeze in Japan because you made some headlines this morning. You believe the BOJ meeting is a live meeting. Do you actually think we could get an interest rate hike?
I think we could, John. It's a really close call. Japan's doing their best to be as vague as possible. The forward guidance always surprises people, just as the first rate hike back in July did. But I think, John, the data in Japan really is fantastic. You've got the Tankan survey, growth surveys picking up. You've got inflation stronger, services, PPI looking really good. Wage data is at the all-time high since 1990s. The last time wages were this strong, John, rates in Japan were at 3%. So I think if it wasn't for Trump's tariffs on Jan 20th, the BOJ would be very happily hiking at this meeting. It remains a very close call. It comes 4 days after his inauguration, so we'll have a lot to make our minds up as to what he does on Jan 20th. If he goes soft on Japan, maybe that's the moment they go for it.
BOJ, January 24. Jordan, appreciate your time. It's good to see you, sir. Jordan Rochester there of Mizuho on a range of central banks there. And some of the moves, the external factors really shaking up markets abroad.
Yeah, well, the Bank of Japan has the luxury of waiting until January 20th passes before they make their decision. There also is reporting from Bloomberg today that the Bank of Japan is thinking about upgrading their inflation forecast on salaries, as well as the price of rice and some other inputs. It just goes to show how they waited to not necessarily hike rates in December, and how now might be the time to go, especially after they get a sense of those policies.
It's amazing just how much of the world will be focused on a number that drops at 8:30 Eastern time to see what happens with the Federal Reserve and how this will influence rates pricing here in the United States and the spillover you'll see to foreign markets. It's kind of remarkable.
It is remarkable how much some of those other markets are susceptible to one that is not their own. And they're feeling that and they're responding to that. And so at this point, at 8:30, you can expect a real potential move globally.
The payrolls report just around the corner. 165 is the estimate, 227 is the previous number. With an update on stories elsewhere, with your Bloomberg brief, let's cross over to Danny Berger. Hey, Danny.
Hey, John. Chinese hackers breached CFIUS, the U.S. government office that reviews foreign investments. CNN reporting the breach happened in December. It was part of a larger incursion into the Treasury Department's unclassified system. U.S. officials are trying to determine the national security risk from that hack. Apollo Management is considering a major stake in 7-Eleven parent company 7&I to take the company private. People familiar tell Bloomberg that the private equity giant could commit as much as $9.5 billion for an equity stake in the plan. Under the proposal, Apollo would join the company's founding Ito family, which also operate Family Mart stores in Japan, as key investors. The buyout team is racing to finalize the deal ahead of a rival offer from Couche-Tard. Tesla has officially launched its new Model Y SUV in China and began taking orders on the highly anticipated vehicle. The new Model Y starts at just under $36,000 and has a single charge range of over 370 miles. The Model Y is one of China's best-selling EVs, with the new model signaling Tesla's effort to inject more excitement into its lineup in China and increase domestic competition. That's your Bloomberg Brief. John.
Danny, thank you. What a tough market it is over in China. More from Danny in about 30 minutes' time. Up next on the programme, signs of softness.
People are not feeling as comfortable now that they can find a new job if they leave their job. So those are the kinds of signs of softness that we're seeing in the data that we think are going to continue to feed through.
Andrew Hoddenhorst is looking for 120. He's near the low end of the major banks we've surveyed here on Wall Street. The range is pretty wide, anywhere from 120 all the way into the 200s. The median estimate in our survey is 165 on this Payrolls Friday. Good morning to you all. It is Payrolls Friday. Equity futures pulling back just a little bit. We're down 0.1% on the S&P. On the Nasdaq, we're down by 0.1 as well. On the Russell, we're down by 0.15. Under surveillance this morning, signs of softness.
Layoffs are low, so that's very good news for the job market. But you also see that the hiring rate is quite low, and that actually surprised us to the downside. People are not feeling as comfortable now that they can find a new job if they leave their job. So those are the kinds of signs of softness that we're seeing in the data that we think are going to continue to feed through and lead to a higher unemployment rate.
So here's the latest this morning. Investors are awaiting the December payrolls report due out in just under 2 hours' time. Economists expecting 165,000 jobs added and unemployment to hold steady. Sarah House of Wells Fargo writing, as we think about how hiring is set to progress in the new year, we expect softer demand for new workers and slower growth in the labour supply to lead to a moderation in the pace of monthly net hiring to around 125k. Sarah joins us now for more. Sarah, welcome to the programme. And just to build on what you've written there, where does that leave pay and wages in the months and quarters to come?
Yeah, so I think we'll see a somewhat further moderation in wage growth. So when we look at the employment cost index, for example, so right now it's just under 4%. I think it's probably going to slow to about 3.5%, but that's going to still be enough to keep real compensation growth positive and I think continue to support the consumer. But I think still looking at a slightly more tepid jobs market, which is going to continue to put some downward pressure on those labor costs for the near term.
At the same time, Sarah, you don't expect the unemployment rate to rise materially. Why not?
Yeah, it really has to do with the supply backdrop. So yes, we're continuing to see demand weaken on trend, although at I think a much slower pace than what we were seeing through most of 2024 and certainly 2023. But we've already begun to see the labor force growth slow quite substantially. So for 2024, it looks like it'll come in about 0.7%. That's less than half of what we saw in 2022 and 2023. We think that moderation continues as you just look at not only the demographic backdrop here in the U.S., but also as we've already begun to see immigration flows slow quite substantially. And so I think that's going to help keep the labor market relatively balanced next year.
At the same time, Sarah, Michael Reed of RBC pointed out that the main drivers of the job growth that we saw over the past year were healthcare, leisure and hospitality, and government. If we do get a significant slew of government cuts, how does that affect job growth in the U.S.?
Yeah, so most government hiring, about 90%, is at the state and local level. So even though there's a lot of focus in terms of federal employment, that's not really going to move the needle. But I am worried about a slowdown in the government portion of hiring, given that state and local revenues have really slowed. So a lot of the funds that were helping prop up those revenues, allowing state and local governments to hire, that had to do with a lot of the COVID relief, that's starting to run out. And we've already seen a lot of restaffing efforts. So I think that's one area where you are going to get less support in terms of the overall hiring picture this year, and it's going to contribute to that moderation in overall job growth.
Sarah, the number drops a little bit later this morning. Appreciate your time. Sarah House there of Wells Fargo on the jobs report we're expecting at 8:30 Eastern time. Lisa, this is a point you've made a few times already. Federal hiring and what it's going to look like in the years to come.
The reason why I'm pointing out the government hiring is because it's been such a major support for some of the numbers that we have gotten recently. If that is a target to reduce that area of hiring, well, what does that do to the overall market, and how fragile does that leave a labor market that is being supported by a couple of pillars but has seen softness elsewhere? It's something that I just think is important to understand and digest in these numbers.
165, the median estimate this morning. In the next hour of Bloomberg Surveillance, we'll be catching up with Mohamed, El-Erian of Queen's College, Cambridge. He'll be with us for 2 hours in the studio, counting you down to payrolls, alongside Meera, Pandit of JP Morgan Asset Management, Matthew Palazzola of Bloomberg Intelligence, and Ellen Zentner of Morgan Stanley. The second hour of Bloomberg Surveillance is up next.
The U.S. economy has been the beacon of opportunity in the last several years.
There's a lot of health in the U.S. labor market because the economy itself is very healthy.
Workers have lost some leverage from the heyday of the Great Resignation when they were clearly in the driver's seat. There is no one in the driver's seat right now.
People are not feeling as comfortable now that they can find a new job if they leave their job. So those are the kinds of signs of softness.
I think the surprise from the report, just given where markets are, is that it could come into the soft side.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The payrolls report 90 minutes away. The scores look like this. Equity futures down by close to 0.2% on the S&P. On the Nasdaq, we're down by basically 0.2. In the bond market, some stability, but still, over the previous 5 sessions, we haven't had a single day of declining yields. Well, that changed today. We're up 2 at the front end on a 2-year to 428.69. The jobs guesses this morning look like this. The median estimate is 165, the low's 100, the high's 268. A range from the biggest banks on Wall Street from anywhere between 120 and 175.
Yeah, the question that we keep asking, and I think is going to be the most important one, is the market response to this number. If it's bang in line, then we can all go home and say, okay, let's wait for CPI next week and retail sales and maybe even earnings. If it is not, what is more punishing to the stock market? An upside surprise or a downside surprise? And I am curious to see the response to that.
It depends who you ask. And it depends what asset class and what country you're looking at. Good afternoon, London. Good evening, Tokyo. Because you know, there's those 2 countries are watching this closely later this morning.
Interestingly, we can't say good afternoon, Tokyo, as much as good morning, Great Britain, or actually the other way around. But I will just say this, that right now the United Kingdom is probably watching much more than the Bank of Japan, just simply because of the vulnerability with the dual deficits, the twin deficits in the United Kingdom, and just how much that bond market has sold off, with yields hitting the highest on the 30-year, going back to 1998 and just continuing to creep higher.
Some of these countries, some of these markets, many of them at the mercy of what happens outside of their own borders. The world's looking to the United States, not just today, but again on the 15th when we get CPI, and certainly again on the 20th when we have inauguration in the United States for President-elect Donald Trump.
It's no longer that the Federal Reserve is a central banker to the world. It is increasingly that Donald Trump is the arbiter of tariffs around the world. And how do other countries respond at a time where they are fiscally challenged and dealing with some doubts about their ability to borrow and spend to the degree that they've planned to?
We've got a lot to talk about this morning. Coming up this hour, we'll be catching up with Mohamed El-Erian of Queen's College, Cambridge on the global bond market sell-off, Meera Pandit of JP Morgan Asset Management on policy efforts in Washington, and Matthew Palazzola of Bloomberg Intelligence on the cost to rebuild Los Angeles. We begin this hour with stocks lower and US Treasuries finding some stability. Mohamed El-Erian of Queen's College, Cambridge, staying focused on the bond market and writing, some label 2024 as ushering in the return of bond vigilantes. This greater focus on debt and political stability is likely to continue into 25, as will the extent of dispersion between the United States, the Eurozone and Japan. I'm pleased to welcome a good friend of all of ours, Mohamed El-Erian. Mohamed, good morning.
Good morning, John.
And a happy new year to you. It's the final day we can say. It's January 10th.
So we'll say it all day.
The rules of Bloomberg Surveillance. Mohamed, are the bond vigilantes back? And if so, what's changed? Why are they back?
They're back because of 3 issues, as you know, John. One is consistently stronger than expected U.S. economic data. 2 is the understanding that inflation will be sticky. And 3 is there's renewed focus now on debt and deficits. Put these 3 things together, the U.S. leads a global bond sell-off, and then what that sell-off does, it picks vulnerabilities in the system and weaknesses, and it wouldn't have been good afternoon Britain, it would have just been afternoon Britain, because they are facing the combination, the emerging market combination of higher yields and lower currency, which is really bad news for them right now.
How much of that is in their own control?
Some of it is in their control, and it is a golden opportunity for this government to redouble or restart its economic approach, which has lost its way a little bit in the last few months. But they will be looking at the U.S. jobs report and critically the CPI coming up. You know, it's not so long ago, Lisa, that we used to say, okay, forget about CPI, inflation's under control, all that matters is the jobs report. Now suddenly we've realized that both are in play, inflation and the employment part.
So when we say afternoon in Great Britain, because no one's saying it's particularly good right now, what is better for them? An upside surprise to labor markets or a downside surprise at a time when potentially that could spur some sort of risk-off move at a time when, even in the United States, people are really questioning the sustainability of what's going on?
Yeah, and that's the issue. If you're in the U.S., you really want an upside surprise. If you had the choice between the two, you take an upside surprise. If you're in Britain, you take a downside surprise. Yields have got to stabilize. Otherwise, you risk triggering these dynamics that can really hurt. So they would hope for a downside surprise that brings yields down here and puts downward pressure on their yields.
When you talk about bond vigilantes and how they find the most vulnerable spots, how long is it before they find the United States particularly vulnerable? And this sort of goes to the heart of the question that Torsten Slok raised, which is it is highly unusual to see the long end yield rise by 100 basis points after a series of 100 basis points of rate cuts from the Federal Reserve. Do you have a sense that maybe the U.S. is one of those vulnerable spots at this point?
In relative terms, no. You've heard me say over and over again, the good, the bad, and the ugly. The good is the U.S., the bad is China, and the UK is Europe, including the UK. The ugly is Europe, including the UK. So US, China, Europe, including the UK. They'll focus on the ugly first, and then they'll creep up. The US has a particularly good spot because higher yields here are associated with stronger growth. That is not the case in Europe.
So why do you think the Federal Reserve is so confused? At least they sound confused, based on the news conference back in December.
How much time do we have?
We've got enough time to go through it.
2 hours.
Okay, so they've been confused in their analysis. They've been confused in their communication. They've been confused in their approach. When you're data dependent and you're just looking at the future through the lens of the past, you will get more and more confused as we go through these changes. And we haven't even talked about policy uncertainty, which adds to this. The reality is right now we could solve at different levels of employment and inflation. Whatever scenario you had for recession, soft landing, no landing, whatever probabilities you had, now each of them is associated with different levels of inflation. And that is new. So the Fed, and you've heard me say this for a long time, has got to get more strategic in its approach and has got to stop being excessively data dependent.
They say this phrase that you use, policy uncertainty, and when I hear it, I just think Donald Trump. What they actually mean to say it's Donald Trump, and you saw that in the minutes, and I think we heard that in the news conference with Chairman Powell. I'm struggling to understand this, and I'd love your opinion on this. Why some officials on the Federal Reserve are willing to preempt policy changes and factor that into their observations and their forecasts, but unwilling to do so when it was Biden in the White House and he was pushing through massive fiscal stimulus into a supply-constrained economy, and they sat there and let inflation rip. What explains the difference between the behavior and response and the approach to two different presidents?
You've got to ask them. We thought we understood how the Fed approached this when Chair Powell said, quote, something along the lines that we don't speculate, we don't predict, and we don't assume anything about policies. So everybody assumed, you know what, let's wait and see. And what we're hearing from the Fed does not incorporate forecasts about policy changes. And then the whole thing got muddled. And now some do, some don't, you're not quite sure what. And I think this is part of a bigger issue, which is Fed communication has gotten really confused. Bill Dudley had a really good piece in Bloomberg Opinion about this. And it does matter because the Fed is supposed to reduce volatility, not contribute to volatility. And for the last few years, the Fed has contributed to volatility.
How do they not contribute to volatility when they are facing off with policies that offer up profoundly different contours of inflation and growth?
So, first of all, they've got to either take the approach of this is what we think the baseline is. We are going to check it every single day against more signs out of DC. Or alternatively, we're not incorporating any new policies. Sometimes you need a top-down, you need the chair to say this is the approach we're going to take for now. Because the muddled middle causes all sorts of spillover effects that are not helpful at all to them.
So let's talk about those spillover effects. We've talked before about how they're at risk of maybe allowing inflation to creep higher, then have to hike rates later. The idea of not recognizing inflation enough. There's the other side of things. If they hold rates too high for too long, they could cause a deterioration, a dramatic deterioration in the economy. Right now, which is the bigger risk?
So the only reason we talk about the inflation risk is because we compare it to an arbitrary target that I'm willing to bet if we were to set today, we would not set at 2%. we'd set it at 2.5 to 3. Every other indication of inflation suggests that inflation expectations are stable. What's structurally happening here and in the rest of the world means that you're going to run the economy for now at a higher equilibrium inflation rate than before. And it's not, so the reason why we're getting in this whole thing is because we are judging ourselves against a target that itself is not only arbitrary, but would not have been the target we would have chosen today. I don't worry, honestly, about inflation until I have evidence that inflation expectations are de-anchored. And there's no evidence of that at all. I do worry that if the Fed truly believes that it has to achieve 2% and wants to do it, it's going to have to hike rates this year. And if it hikes rates this year, it's going to pull the rug from under U.S. growth. It's going to pull the rug from under U.S. investment. This is how important it is. So my expectation is they'll fudge. They'll say we continue to pursue 2%, but down the road, they'll stick with a 2.5% target forecast for now, saying on the way to 2%, but we'll basically be living with a high inflation target.
Mohamed, we're lucky to have you. Lots to talk about and lots of time, fortunately. You're going to be sticking with us through payrolls. At the moment, equity futures are negative by close to 1/3% on the S&P. With an update on stories elsewhere, with your Bloomberg brief is Danny Berger. Hey, Danny.
Hey, John. Firefighters are making progress in controlling the wildfires in Los Angeles. The Kenneth fire is now 35% contained, and the Palisades blaze is showing early signs of control. The wildfires have claimed the lives of at least 10 people, damaged or destroyed 10,000 structures, and forced 180,000 residents to flee. A check on Delta shares in the pre-market, higher by more than 6.5%. The company reported fourth quarter profit that beat estimates thanks to gains in international and corporate travel. Delta's revenue is expected to increase as much as 9% from a year ago. CEO Ed Bastian saying the supply-demand balance is as good as I ever can recall it being as we look into 2025. Meanwhile, President-elect Donald Trump says that he's planning to meet with Russian President Vladimir Putin after he takes office. At a meeting with Republican governors at Mar-a-Lago, Trump told a reporter that the Russian leader wants to meet and that they are setting it up. A Kremlin spokesman said that there were no specifics yet about organizing a meeting. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes. Up next on the program, Donald Trump prepared to hit the ground running.
President Trump knows this job already. He knows he's got 4 years. He's not going to waste one moment. He'll do tremendous on the executive orders, but he needs the legislative body to catch up to him.
Up next on the program, Anne-Marie, the nation's capital, and Meera Pandit of JP Morgan Asset Management, live from New York City this morning. Good morning. Equity futures on the S&P negative here by 1/3% on this payrolls Friday. In the bond market on the 10-year, we look like this, just about unchanged and just south of 470 on a 10-year, 469. Under surveillance this morning, Donald Trump prepared to hit the ground running.
President Trump knows this job already. He knows he's got 4 years. He's not going to waste one moment. He'll do tremendous on the executive orders, but he needs the legislative body to catch up to him. One of our greatest threat is our debt, okay? But we've got to do a lot of things going forward. The debt ceiling is not a part of that. You should take that out of the way, let the president be able to govern, do the job that has to be done.
So here's the latest this morning. President-elect Donald Trump planning to issue executive orders on immigration, energy, federal workers and regulatory reform immediately after his inauguration. Anne-Marie joins us now from the nation's capital down in Washington, D.C. AMH, how busy is day one going to be?
Well, it's explained to me that the first 48 hours are really going to be executive order after executive order. Now, this isn't new for any incoming president, especially when they're handing off power to the other party. To give you some color and a sense of what we expect, Nancy Cook, one of my colleagues here in Washington, D.C., has a long list of what the team is starting to prepare. On the energy front, new drilling on federal lands as part of his initial push. Trump is also going to freeze regulations put forth by the Biden administration that have not yet been finalized.
when it comes to federal workers. They're trying to shrink the federal workforce by putting a hiring freeze on the government and mandating that they return to office. Is something we've heard Elon Musk talk about when he wants to Dogify the country. And then, of course, on immigration, this is going to be the most important. This is the one the president feels like he has a mandate from the country on. They want to tighten restrictions on border crossings, mandate that the government finish the unbuilt area of the border wall, set up the mechanics to also carry out mass deportations, and also deprive any sanctuary cities of federal resources until they stop serving as a safe place for migrants. So it's going to be a very busy first few days of the Donald Trump administration.
Lisa, we talked about this a little bit earlier this morning, the fact that we're not talking about tariffs, that tariffs weren't part of that report, which was surprising to me because I thought on day one you'd start to see some policy on that front too.
So basically on January 20th, expect a rally in currencies around the world and a decline in the dollar. And then on January 22nd, when they actually do come out, you can reverse all of that.
AMH, appreciate your time. Anne-Marie down in Washington, I'm not sure if it's going to be that simple, but we'll see. Meera Pandit at JP Morgan Asset Management can try and make sense of it all. Meera, good morning and Happy New Year.
Happy New Year.
It's good to see you. Let's talk about your underlying assumptions for policy changes in the months to come from this administration, the way you're thinking about emphasis and sequencing through the next year.
There's three key areas here when we think about taxes, tariffs, and immigration. So you hear a couple of the headlines of what's coming first. I think we'll see a lot of that coming through in the first 100 days. But the sequencing still is important in terms of what gets enacted when. So you could see tariffs come to the fore right away. The implication of that from an economic perspective is really on inflation. And you could potentially just see a one-time pass-through that lifts inflation in 2025, but remains to be seen exactly how that might play out. If you think about immigration, similar impact there if we see immigration reform, tighter labor supply, potentially tighter on the labor markets there, and potentially inflationary there as well. Tax is the key question here because even if you do see big tax reform, there's two big questions. One, if it is mostly an extension of the Tax Cuts and Jobs Act, that's not necessarily going to have a huge impact to growth coming forward. And two, if you don't see that come through until 2026, then you have a little bit of a timing issue where you see some of the more inflationary policies come first and some of the more pro-growth policies come second, which wasn't the case during the first administration when you saw that nice impact to earnings from tax cuts at the same time as you also saw that drip feed of tariffs.
Does that mean that you think that there's going to be the same or a similar amount of policy-driven volatility this year as we saw, say, in 2018?
It's very likely. We're likely to see many pockets of volatility brought on by this drip feed of tariff news as we're likely to get. And if we use 2018 as a guide, throughout the year, you did see that drip feed in terms of policy in the tariff realm, but you did have an underpinning of those tax cuts that did help boost earnings about 20% that year. But we expect that politics will be unpredictable. We don't expect that the Fed is going to be unpredictable. Their job is to be predictable. So the challenge we saw in 2018 was that despite all of the hiccups you saw throughout the year in terms of tariffs and what will and won't happen and what did happen, ultimately the biggest pullbacks from 2018 were really Fed-driven when people were worried about an aggressive Fed.
So are you saying that essentially this is a market that continued to climb higher, that can continue to broaden out, and I'm talking about equities in particular, unless, as you write, monetary policy becomes the unwelcome dark horse? As long as monetary policy is on some sort of steady path, you think that the risk assets, risk markets can really look through some of the fiscal policy volatility?
Even in the absence of a tax cut this year, any tax cuts in addition to the extension of the Tax Cuts and Jobs Act, even if that takes place in 2026, we're still expecting very strong earnings growth. So there's a very strong fundamental backdrop in terms of growth, already an above trend level. We have a nice buffer there for things to moderate a bit. Profit growth expected to be 15%. Even if we get 2/3 of that, we're still looking at double digits from the earnings side of the house. So ultimately, I do think that policy is going to continue to cause some volatility, but we don't want a big surprise from the Fed. I think policy can potentially be, on the government side, a source of volatility, whereas the Fed could potentially be a source of correction. And there is a lot of uncertainty exactly about what the Fed might have to do next year. I mean, the Fed has an unenviable challenge of fighting last year's inflation with today's data and the specter of tomorrow's inflationary pressures from policies that they don't exactly know where going to pan out.
Meera, we spend a lot of time on the what of the policy side. Can you tell us a little bit about the how? In particular, do you think that someone in Washington is bringing together all these various elements and solving a general equilibrium model of some sort to see what the effects of all these measures would be?
Ultimately, the challenge is, even if you do have a centralized strategic initiative towards all of this, when it comes down to legislating, and when you think about Congress, there are so many competing interests because of everyone's different constituencies and what different people want. So that's how you end up with things that seem like a bit of a Frankenstein, and this is true in any administration, any legislation, because you're trying to please a number of parties. And the other challenge that we're dealing with, of course, is very slim margins and very slim majorities in Congress that are going to make some of that negotiation quite fraught.
And yet, I completely agree, okay, we hear quite strong prediction as opposed to embrace volatility. That's going to be the theme. On the price pass-through, we all say it's a one-time price pass-through, but that assumes companies don't learn. And companies were shocked in 2022, the whole cost inflation surge, etc. And there have been changes in how they think about adjusting prices. So are you really confident this is a one pass price through and that's it?
There's no confidence when it comes to thinking exactly about how these policies are going to even be enacted, let alone play out. So all of this is taken with a grain of salt because, of course, it is highly speculative as to exactly what's going to happen here. But I will say when we think about companies versus consumers, consumers have very little appetite to take on higher costs. And we saw that in the exit polls of the election, that prices were a big sticking point there. We're really going to have to look to companies to have to absorb some of this because, look, if you're in a backdrop of 15% potential earnings growth, of record margins or near there, great margin expansion last year, margins holding up last year as well, then the little bit there, you're looking for companies to shoulder some of that burden.
You look across the world, what happens to go right in the rest of the world for international markets to start working?
There is an upside for different international markets. I think about Europe, where growth is incredibly weak. But there is the possibility that you could see some fiscal stimulus in Europe. There is the possibility that when you think about financial conditions, very tight in Europe, not so much in the U.S., some loosening of that could help markets overseas. The ECB is, of course, going to lower rates and probably a lot more than the Fed and a lot faster. So the actual interest rate sensitivity, when you think about the European economy from the perspective of more bank lending than we see in the U.S., mortgages that are variable or fixed for a shorter period of time, you actually could see a nice tailwind to the economy in a way that it's harder to see sometimes in the U.S., given interest rate sensitivity. You could have a scenario where the administration does want to be very tough from a tariff perspective on China, but is actually willing to make deals with areas like Europe, Canada, Mexico. So if you have any area of trade policy that's tough on Chinese autos, for example, that would be a huge tailwind for Europe. Yep. And then add in one more perspective. We have spent down an enormous amount of consumer savings in the U.S., and that's been great for our economy. Europe still hasn't. So there is some room for that, too, if you can drum up enough confidence.
Confidence there. Rock bottom at the moment.
Which is sort of the hope that maybe we are at rock bottom. And that's what we keep hearing, that maybe there'll be a washout. And this is the moment where suddenly the expectations are so low that any positive surprise, any consumer spending, what a great thing.
Meera, it's good to see you. Appreciate your time. Meera Pandit there of JP Morgan Asset Management. Over in Europe, I've been surprised how reluctant the ECB is to get very dovish. Like extremely dovish and come out and talk about how bad things actually are and how they need to respond.
How much space do they have to do that? They just saw upside surprises in inflation readings that we saw in Germany. We also see natural gas prices. This is one of the sticky inflation aspects that's really been a conundrum to a lot of different central banks.
And there's single mandate central bank. Never forget there's single mandate central bank.
If they weren't, I imagine they'd be doing something very different.
You know, in this point, I actually wonder if they're kind of glad that they're not. At a time where there isn't political leadership and they'd have to be charged with all sorts of political interference, maybe they can just say, we'll stick to the inflation.
Keep going back to the Federal Reserve, don't we?
I'm just saying, I think that they have a real quagmire right now in trying to figure out policy that could change the trajectory dramatically.
Don't you think a lot of it is of their own creation at the Federal Reserve? Don't you think the communication of Powell from one meeting to the next, to say to Mohamed's point, we don't assume, speculate or guess, and then turn around a month later and say some do?
It is the Fed's own creation that they took such power, I think, going back to 2008, even though they're not politically elected, and so it raises this extra question.
That conversation will continue on this programme. Up next on the programme, Matthew Palazzolo of Bloomberg Intelligence on the cost of rebuilding Los Angeles. That conversation is up next. The opening about 2 hours away. The jobs report 60 minutes away. And going into all of that, equity futures negative by 1/3% on the S&P. On the Nasdaq, we're down by 0.4. So just pulling back just a touch. We're 2 hours until that cash open. Let's get you some morning movers. Let's cross over to Manus Cranny. Good morning, Manus.
Jonathan, good morning. The world is trying to grapple with what's happening in LA politically, and from a human point of view, the horrors are all there to see. But this is about the financial repercussions, and that's what we're beginning to put some numbers around. Travelers Inc. JP Morgan have doubled their estimate in terms of the actual cost of these wildfires to $20 billion. That is overnight. Now, there's a consequence to that because a number of stocks are impacted, Allstate, Chubb, and Travelers. Travelers is perhaps the most exposed. Primary insurers will bear the majority of the burden. This is a more significant and more severe impact than the Butte County Camp Fire in 2018. So this is, in some way, a financial translation of the horrors of the LA situation. To Nike, a vote of confidence in the new CEO. You've got Piper Sandler upgrading the stock to overweight. Elliott Hill's intensified urgency. Possibly early with their call is what they're saying, but healthy, profitable growth might not just be now, it'll be 4 quarters away, but it's a nice upgrade for them. Upgrade yourself. Apparently millennials do. This is for Delta. Overseas business, travel, both of those combined. Nice rebound in the Delta numbers. They've also guided higher. This quarter they're going to make up to $1. The market had estimated around 76 cents, so 75 up to $1. Free cash flow, $4 billion in this first quarter, Jonathan. That's up 18%. And as I say, 85% of the seats that this company is going to put into their plane, they are premium seats. Millennials. I never afforded business class travel when I was a millennial.
Of course not. No. Manus Cranny, of course not. I used to fly with Manus. I'd take a right, Manus took a left every single time. That's how it went. Manus, appreciate your time.
Wait,
cut the mic now.
No.
He can't respond.
Pause.
He can't respond.
No, pause. You, as a young lad.
As a young lad?
As a young lad.
Ryanair.
Yeah, you, wait.
Didn't allocate seating.
So hold on a second.
Across the tarmac and try and get a seat and block the other seats for your family.
You were the person who actually sprung for the high end when you were like 23.
Absolutely not.
100%.
No way.
Yeah, you were like in the lounge.
Ryanair.
Sipping champagne.
London Stansted into Bari.
When did that change?
No seats when I got a job. No seats. Used to run across the tarmac. Used to try and block the seats for your family.
Yeah.
And how do you block the other seats? Is it a short?
Do this. They're taken. And then someone would say they're not taken. Where are they? And I'd say they're coming. And then then the row would start. It was some violent stuff with Ryanair. They'd try and take your bag off you and say it was too big. They'd force you to put it through this metal thing to see if it was too big or not. I'm sure they still do that. Michael O'Leary's made the experience a little bit more pleasant, I have to say, over the last decade.
Those days are long gone. Now you're full-on lounge.
Yes, and I charge it to work, as I should. Under surveillance this morning. Delta Airlines beating profit estimates in the fourth quarter, seeing gains in international and corporate travel. The airline expecting elevated demand through the year, as it also continues its push into premium products and services. The stock is up by close to 7% this morning. Phenomenal performance from that company over the last few years. Really a market leader in America in many ways.
And how much does this really point to an industry-wide standard that they all can charge more because there just have been fewer plane deliveries, which has lowered capacity. They're all trying to shift into premium because evidently millennials today don't want to do the Ryanair experience where they go to fisticuffs with other people about saving seats for people, which maybe isn't a terrible thing. But it just speaks to this idea also of international travel and how that has continued to be strong. And I wonder how much that has to do with the dollar.
There is an obvious bias around the table we should reveal. Delta, American, United. You know, we all have our own airlines here. Mohamed, can we make the shift to Delta? Does that work for you? Or are you just staying with United?
I'm happy for Lisa to stay with United.
Ooh. Shots fired.
Yeah, no.
What's so special about United? What's Kirby done over there that makes you just so loyal to that airline? What's it about?
I think it's more about me than about United. I like predictability, and I know exactly what the seat's going to look like. I know exactly what service I'm going to get. I know exactly what food I'm going to get.
The street waffle.
No more street waffle.
No more street waffle. They killed that. When did they kill that?
About a couple of years ago.
I didn't know that. Why did they kill that?
I don't know. You should ask.
It's your favourite snack. All right. It's a conversation for another day. A brutal week for UK bond traders coming to a close. 10 and 30-year yields jumping more than 20 basis points. The important stuff, Bramo.
Evidently.
Over the last 5 sessions. The most in a year. The 10-year yield hitting its highest level since 2008. The 30-year since 1998. Investors concerned about Labour policy and an escalating government debt burden. Mohamed, we talked about this a few times already this morning. What do you think is the biggest difference now, between now and, say, 2022 and the so-called Liz Truss moment?
I think it's a functioning of markets. So 2022 was a breakdown in the functioning of markets, and that immediately spread the disorder all over the place. Here, the markets are functioning well, but the economy is going to have to deal with higher yields at a time when there's very little policy flexibility. So this basically eliminates all the headroom that the Chancellor had on fiscal policy, and it will also constrain what the Bank of England can do.
If there is an upside surprise in U.S. payrolls, I just wonder how bad that afternoon is going to be in the United Kingdom at a time where right now markets are orderly. If there is a huge moment of volatility, does that change?
Important stuff. One more note. You know the street waffle? And it's an important note. Do you know it was designed to sit over the cup so that it softened, the caramel would melt a little bit?
Yeah, of course.
That's why it's that size. You know, I didn't know that. I didn't know that until recently. You're meant to put it on top of a hot coffee or something, and then it melts a little bit.
Correct.
That sounds absolutely dreadful on an airplane
Did
to
you know
have
that?
melted caramel all over the seat.
No, it stays in the street waffle.
All right, well,
it stays in there.
Maybe they're moving to more healthy
Just saying, you learn something new every day. I learned that the other day. President-elect Donald Trump, I want to squeeze this story in, saying a meeting with Russian President Vladimir Putin is being arranged, telling a group of GOP governors gathered at Mar-a-Lago that Putin, quote, wants to meet, and that any such meeting will take place post-inauguration.
Russian authorities said that they haven't been contacted, so that they are not necessarily, this is according to a number of sources. Nonetheless, there is real speculation about how quickly President-elect Donald Trump will move to end the conflict between Ukraine and Russia, and just whether this gives Russia more leverage, whether this will leave Ukraine with a worse deal, exactly the contours of this, and just how on board Vladimir Putin actually is.
Yeah, watch this space. Let's turn back to the tragedy in Los Angeles. Multiple wildfires continuing to burn throughout the city. Nearly 200,000 residents have been forced to flee their homes, and 30,000 acres have been scorched so far. Firefighters working round the clock to try and contain the fires. Joining us now is Alex DaSilva of Accuweather. Alex, welcome back. Are things getting any better?
Yeah, unfortunately, things continue to get worse, and we have the numbers here. 92 wildfires in total have broken out across Southern California. Of course, we have the main 2 or 3 or 4 fires, but there's been other ones that have been sparked by some of those embers blowing ahead of the main parent fires and sparking new fires. Unfortunately, we've had 5 confirmed fatalities, but I've seen new data that would suggest that number is closer to 10, unfortunately. And like you mentioned, about 30,000 acres have been burned, along with 10,000 plus structures. Again, we're tracking the 3 main fires, Hearst, Palisades, and Eaton fires. And unfortunately, each and every one of those fires is 10% or less containment right now. The winds continue to blow pretty strong in Southern California, and I think they'll continue to do so throughout the day today. They might relax a little bit tonight, but it looks like this weekend they might pick up yet again, unfortunately. This is all fueled by a big area of high pressure that's moving down across portions of Nevada. That is what has caused this event in terms of the winds. Low pressure to the south, and then kind of that gradient between them causes this wind coming out of the east. So that's why we've seen these very strong winds across the area. New damage estimates from Accuweather. Now we're calling $135 to $150 billion in economic loss across Southern California, and that's about 4% of California's annual GDP. Now, this is not just physical damage. This is insurance losses as well, tourism loss. We look at the NFL game that has been moved to Arizona. That is also factored into economic loss as well. We look at healthcare premiums. Those might come up a little bit with all the smoke, people having allergy problems due to the fire. So it's not just about the physical damage. When you have an event like this, it really goes much more beyond, unfortunately, the physical damage. And then how does this event rank amongst other natural disasters that we've seen in recent times? You can see the Cal Fire is up here, and it's very considerable.
Pretty shocking stuff, Alex. Appreciate your time, sir. Alex DaSilva there of Accuweather on the latest. Let's talk about the cost of things. Bloomberg Intelligence expecting that insured losses from the California wildfires could be between 10 and 20 billion US dollars under some scenarios, saying it will be a large but likely manageable event for public insurers. Joining us now is Matthew Palazzola of Bloomberg Intelligence. Matt, it's good to see you, sir. Under difficult conditions over in Los Angeles, do we know what started this fire? Have we got any detail whatsoever?
As of yet, no. So CAL FIRE is really the source you go to for this, and they're saying still under investigation. I mean, I think they're still focused on, fighting it at this point, and usually that comes out it could be even months after.
Do we have a sense of what proportion of homes that were destroyed were actually insured by some of these public insurers versus either completely uninsured or insured by the insurer of last resort, the state?
Yeah. So in the main affected zip code, about 15% of those homes are in the FAIR Plan. I don't have data on uninsured homes. Anecdotally, you sometimes hear these very, very high-end homes, maybe they go without insurance because it's so expensive, but I mean, generally they're mostly insured. So mostly insured with about 15% in the FAIR Plan.
Can you give us a sense of just how many insurers pulled out of California in the years leading up to this because of some of the mandates coming from local legislation?
Yeah, so the biggest ones did. So State Farm has been pulling back, Allstate has been pulling back, a number of smaller ones have been pulling back. And what they've said publicly is wildfires, climate change, but Lisa, like you said, the regulatory climate there is very difficult for them to operate. So it is actually, I would think, the primary reason a lot of them pulled back. Just for an example, that FAIR Plan, the state kind of doesn't run it, but gives it powers and kind of has power over it. They made the FAIR Plan increase the limits that they take, right? So they have to insure a higher amount. And the FAIR Plan said, well, we need more rate, and then the state didn't give them as much rate as they needed.
So, Matt, take us from what has happened to what is likely to happen. Typically, after a tragedy, we see two things in the insurance market: higher demand for insurance, lower willingness to supply insurance.
Yep.
So what do you think happens here?
Yeah, no, I think that will happen here. I've got this kind of blue sky scenario that maybe this forces the state regulators to the table to work with the insurers a little bit more. It's probably an unlikely scenario. I think what happens is you will see a opportunity for the residual market insurance companies or excess and surplus insurance companies that don't operate kind of in the more regulated space to write these kind of more freer form policies. But I don't think this helps the cause in the state at all. In fact, I think the FAIR Plan the solvency of the FAIR Plan could be at risk.
So when we are sort of trying to think about how quickly the rebuilding goes on, how quickly do we get back to a new sense of normal, do you think the insurance element is a big issue to think about or just a marginal issue at this point?
So I would say, I think the rebuilding happens fairly quickly. You could look at like the Maui fires and like, we get to work on that stuff pretty quickly. I don't think, we talk about, there was hurricanes last year and flooding there, and there's more of a chance that perhaps insurance doesn't pay for some of those things than with the fires. With these wildfires, they understand that it's risky and there could be carve-outs, so I'm not saying everyone gets coverage, but there's probably less of a question of insurance coverage in a case like this.
If the FAIR Plan is insolvent, which is what you raised the specter of, and I just want to end there, this is the California Program of Last Resort. They insure up to $3 million, I believe. A lot of these homes are far beyond that. Do we have a sense of what the necessity will be of California for federal financing to cover any kind of additional funding at a time when I think it's $700 million the FAIR Plan has currently in financing?
Yeah, so the FAIR Plan's financials are not exactly public, right? So we don't know the ultimate claim paying ability. They will, first step is they can access a line of credit. I don't know who's going to give them a line of credit. Maybe the state gives them a line of credit. Then they assess insurance companies, and they can keep assessing insurance companies, but once they get over a certain amount, the insurance companies can pass that cost on to policyholders. So there's a couple of things in the waterfall before federal funding. I'm sure some FEMA money comes in, but they have some kind of stopgaps before that happens.
Matt, thanks for your time. Appreciate it. Just devastating stuff coming out of Los Angeles and beyond. Matthew Palazzolo there of Bloomberg Intelligence with an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Walgreens shares up nearly 11% in the pre-market trade. It reported stronger than expected quarterly results that helped to ease pressure, with Walgreens currently considering strategic options, including a sale. Revenue for them came in at $39 billion for the quarter. That's thanks to higher prices for branded drugs and prescription volumes at Walgreens' U.S. retail pharmacy division. U.S. tech billionaire Elon Musk has waded into Germany's election, hosting a conversation with far-right candidate Alice Weidel on his X social media platform. The discussion ranged from Hitler and Stalin to aliens and a human settlement on Mars. It lasted just over an hour. The X Spaces event with the leader of the Alternative for Germany party comes ahead of federal elections for the country next month. The Supreme Court hears arguments today on TikTok. It's the company's last-ditch effort to keep the social media app running in the U.S. A federal appeals court had upheld a law that will ban the app if it isn't sold by its Chinese parent company, ByteDance. President-elect Donald Trump is asking the court to hold off on the ban, which would shut down TikTok on January 19th. And that's your Bloomberg Brief. John.
Danny, thank you. Appreciate it. I just wonder, and I've been thinking about this over the last week or so with the changes at Meta. Is Meta and Mark Zuckerberg doing enough to change the incoming president's mind all over again on TikTok?
We shall see. I think it's is it Mark Zuckerberg's role or is it the number of followers that the campaign has assembled on TikTok, as we've kind of heard?
We've heard a few arguments. He doesn't want to help Meta. I wonder if Meta's done enough to change his mind on that front, but I'm with you too. He's popular on the platform and probably wants to stay that way.
Does he really want to anger the kids?
She's not running again, is he?
I don't know.
Some Democrats might be out there. That's a different channel, Bramo. You want to pretend that Trump's running again? All right, different
Stop!
channel.
No.
Different channel.
Different
really? Channel.
All right, let's
freaking out about term 3 and dictatorships. Wrong channel. Up next on the program, the payrolls report.
This is a moderating labor market. It's softening or going into softening, and that's not one where you can look at an individual kind of outlier number and really change your whole forecast for that.
That conversation up next, live from New York. Let's hope I'm still here after the break.
How about me?
This is Bloomberg. Equity futures on the S&P 500 on this payrolls Friday, with that number dropping in about 40 minutes' time. Equities down by 0.2%. Bond yields just about unchanged, 468.75. Under surveillance this morning, the payrolls report.
This is a moderating labor market. It's cooling, it's softening or going into softening, and that's not one where you can look at an individual kind of outlier number and really change your whole forecast for that. I do think that there's still more room for it to cool. We do see the unemployment rate gradually rising over 2025 up to 4.4%. We do think that there is real reason that maybe post Q1 there's going to be a lot more discussions on whether the labor market's weakening.
So here's the latest this morning, less than 1 hour away from the December payrolls report. The median estimate in our survey calling for 165,000 jobs added and unemployment holding steady at 4.2%. Ellen Zentner of Morgan Stanley saying the labour market is gradually cooling, which makes sticky inflation the determinant of how long the Fed pauses. Prudent policymaking would dictate a wait-and-see approach to gauge post-inauguration policy. Ellen joins us now for more. Ellen, good morning. Good to see you.
Good morning.
Happy New Year. Thanks for being with us.
Yes, Happy New Year.
This is a little bit of a change because coming out of the summer, we were worried about employment. We weren't worried so much about inflation.
Yeah.
What's changed in the last few months?
Well, I think inflation has been sticky. Employment, yes, continues to gradually slow. That's fine. That's normal. That's what you want. But inflation has been more sticky, and the Fed has cut rates by 100 basis points. Growth is strong. Financial conditions are loose, although we can talk about the backup in yields. And so there's this sort of wait and see, which I believe in December, really the words they used in the statement indicated a hard pause. And the thing is that you've got this big looming event. What is that? It's the inauguration and the flurry of executive orders that can come out of that. And until you really start to see the shape of that, a lot of uncertainty tends to create policy paralysis, where it just makes sense to hold.
So is there anything that we could get today in about 40 minutes' time that could shake the paralysis that you expect at the Federal Reserve? The rule of thumb is that if you get a horrible number, and it's a horrible number it's an outlier until you know otherwise, right? One data point does not make a trend. I think what you have seen is that if data is disappointing, we've seen at least bets that they could hike at some point come off the table. So I think you continue to take that away in terms of the market expectations of what the Fed might do. Certainly the expectations of when they could start up cutting again would be pulled forward
if we got a really terrible number, but I don't think it's going to change January's decision.
Do you have confidence, and I'm thinking about what Andrew Hollenhorst has been saying over at Citigroup, do you have confidence that the pillars of the labor market growth are strong enough to keep going without participation by other companies and real growth stemming from some additional places?
Well, as long as layoffs don't pick up. I mean, hiring has been slowing, right? But the other part of that equation is layoffs. When hiring is very slow, it doesn't take a tremendous rise in layoffs to push those numbers down to very low or negative jobs prints. And so we've got to focus more on layoffs because hiring is not going anywhere. There's not a lot of churn in the labor market. And so it's a fine balance when it just matters, our companies laying off. We're not seeing that yet broad-based.
It's not so long ago that the view was inflation is orderly declining to 2%. We don't have to worry about the CPI report. It's all about the employment report. And the risk is to the downside.
Yeah.
Now that has changed. So speak a little bit about how do you see inflation dynamics going forward?
So I think inflation dynamics, you saw, Governor Waller express confidence that, look, I still believe that it's going to gradually move toward our 2% goal. And I think if the economy slows enough, and maybe this backup in yields helps the economy slow further, maybe some of Trump's policies helps the economy slow further, then you can get more downward pressure on inflation. And I'm talking about beyond tariffs. Right? Tariffs are going to be a one-off level shift in prices. As a policymaker, you should look through that because the hit to aggregate demand is going to have a gravitational pull on inflation later. And so I think confidence that it will continue to move gradually toward 2%, that's fine, but not in the near term. And so that does support probably a Fed pause here. You've also had a lot of change, Mohamed, at the January meeting, right? That's the housekeeping meeting where we see the shuffle, we shuffle the deck in terms of voters. The divide on the committee becomes even greater. And so unless the data is very clear, there's going to be no reason for them to move.
The probability of a hike this year?
I would say very low.
How low?
I don't put zero on anything. I learned that early in my career when I did say zero one time and I was wrong. No, I would say 15%.
It's pretty low.
How's that?
How helpful are the forecasts at the moment, or unhelpful?
The forecasts are all, look, economists love to say, it's tremendously uncertain. It's hugely uncertain. You can't do a dang thing about your forecast until you know what's going to come out of the administration.
Some people are, though. We've been told.
Yeah, but we have to, right? If you're forecasting the economy, you have to have a baseline. But you see that the baseline that everyone has for assumptions on how far will tariffs go, how many folks will we deport, are they economic contributors to the economy, or are they incarcerated or in the federal prison system, right? It matters who we're deporting as to whether it has an impact on the economy. Who knows? Take your pick. If you tend to lean bearish anyway, choose a baseline that assumes that tariffs are more onerous and immigration is greater than we think. If you tend to be a more bullish person on the economy, decide that Trump is not going to do much of his policies promised on the campaign trail at all. So it's something for everyone.
It's going to be a big year ahead, that's for sure. Yeah. Ellen, appreciate your time,
Thank you.
Always. Ellen Zentner of Morgan Stanley. The next big stop for this debate, Lisa, 34 minutes away.
Yeah.
Payrolls.
As we get a sense of just how much momentum there is left in the market and the market's response to potentially a downside surprise to those numbers.
Stay tuned, 8:30 Eastern Time. In the third hour of Bloomberg Surveillance, the lineup looks like this. Nadia Lovell of UBS, Mike Collins of PGIM, Stephanie Roth of Wolfe Research, and Jeff Rosenberg of BlackRock. From New York City, this is Bloomberg.
You at least want to keep an eye on the labor market. That's really the only point of concern.
I think right now it's actually the unemployment rate. That's probably the single biggest data point we're going to get.
I don't think things are as calm in the labor market as the Fed kind of in their latest projection seems to view it.
This is a moderating labor market. It's cooling. It's, softening.
If NFP is strong, then the Fed's cuts really come out of the table, or if it's a really weak number, equities are probably going to look up and say, hey, maybe the economy is not as strong as we thought it was.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The payrolls report 30 minutes away. The third hour of Bloomberg Surveillance starts right now. Let's start with equities, move to bonds, and then I'll get you the guesstimates. Equity futures right now on the S&P 500 negative by 0.1%. On the Nasdaq, we're down by 0.2. In the bond market, I want to think about September 18th. September 18th on a 10-year, we were trading at 364. That afternoon, the Federal Reserve cut 50 basis points and then went on to cut another 50 over the next two meetings. Since then, they cut 100. This market moved 100 in the other direction on 10s. We're trading at 468.95. The next stop for the debate around the Federal Reserve, part one of a two-part story. It's payrolls today, and then it's CPI next week. The estimate for payrolls this morning, we're looking for 165. On Wall Street, of the 4 or 5 big banks we track, Citi's at 120 at the low end, Bank of America at the high end at 175.
Key question is, how much is this market really dependent on an upside surprise? And I'm talking about equity markets that have actually remained remarkably resilient in the face of this 100 basis point rise that we've seen in longer term benchmark yields. If there is a downside surprise, will the rally into the bond market A, be really significant at a time where people are also worried about deficits, and B, be enough to really support equity markets that are hinged on growth, not just the rate story?
How much can change on one data point? We came into 2025 wondering whether this Federal Reserve could cut at all. Just before the commercial break, Mohamed was asking whether we'd need to hike interest rates later on this year. Mohamed, I'm sitting here wondering how quickly this can change all over again, and whether with a weak print in 28 minutes' time, we'll be discussing rate cuts all over again.
We could well, John. If you think of it, there's normally three anchors to views. One is policy. That's forward policy guidance. That's all over the place. So policy right now is not an anchor. Policy is a contributor on both sides, government side and central bank side, to volatility. The other anchor is technical. That's not much of an anchor because everybody has become data dependent. So you're left with hopefully the economy can be strong enough to act as an anchor. And the reason why we obsess about these numbers is because we are testing that hypothesis over and over again.
We'll see how strong it is at 8:30 Eastern Time. Bond yields into that higher by just a basis point, looking at the UK, because the UK will be looking at us in about 27 minutes, hoping that we get a downside surprise on the jobs report. Here stateside in America, the 10-year, just about unchanged. Coming up on this programme, we'll catch up with Nadia Lovell of UBS with stocks on track for a losing week, Mike Collins of PGIM as the US bond market sell-off stalls, and Jeff Rosenberg of BlackRock reacting to December payrolls. We begin this hour with stocks lower as investors await the last payrolls print of 2024 and the first big data point of 2025. Nadia Lovell of UBS is staying bullish and writing, we remain constructive and expect the S&P 500 bull market to continue, supported by robust earnings growth. However, 25 could be a bumpier year due to government and monetary policies. Nadia joins us now for more. Nadia, good morning. Good to see you. What are you expecting on the government side? What kind of changes are you expecting from January 20th onwards?
You know, it's evident, it's very clear. We already hear news that President Trump is preparing several executive orders the first week as he takes the helm. And so what we expect to see some tightening on the border. We expect to see tariffs. We don't expect universal tariffs, but we expect selective tariffs continue against China. We don't expect to see any sort of changes to the corporate tax rate. We don't think that it will be in the budget. But we do think that overall, the policies will cause some volatility. At least the rhetoric around the policy will cause some volatility to markets.
Let's go with immigration first, and we'll break it down and we'll start there. Labour supply has been a huge feature of every conversation we've had about the labour market for the last several years. If you begin to constrain that and that story changes, where does that leave price pressures and wage growth?
Absolutely, because when you look at the last year, we know that the increase in labor supply has helped the job market. So the job market has loosened a little bit. And so if you do tighten the borders, it will affect in terms of some areas of the economy, particularly the lower wage workers, like when you think about consumer discretionary, restaurants, and those things can come under pressure. And you could see some upward increase again in terms of wage pressures. And that has implications for inflation. This is partly why you heard some of the Fed governors and the Fed participants in December saying that some are factoring the potential for increase in inflation due to the uncertainty around government policies.
There's been some fear that today good news will be bad news for equity markets, that essentially if there's higher than expected hiring and in particular wage growth, that you could see a 10-year, 30-year yield that climbs higher, that torpedoes some of the optimism for Fed rate cuts. Do you think that's the biggest potential risk, or is a bigger potential risk a downside surprise that questions that pillar that Mohamed was talking about of the momentum and growth underpinning this economy?
I think for equities, equities do want to see a fairly strong number to speak to the continued growth in the economy. We've had an economy that's been grown above trend. We've seen equity be able to perform despite the fact that you've seen a pickup in long end yields because the growth picture has been strong. Now, in terms of sort of the more interest rate sensitive areas of the markets, like yes, they've been under pressure due to rates backing up because it does price out some additional Fed cuts. And the Fed right now is quite focused on inflation. So I do think that wage part is important, and then the inflation number next week will be important for the Fed decision.
What is the most interest rate sensitive part of this equity market?
Look at real estate. Massive pullback since, the Fed pivot again in December. You're seeing pullback there, parts of consumer staples, and then housing. Housing has been under pressure quite a bit. You've seen the backup in mortgage rates again, and you've even seen inventory start to build within the housing market, despite the fact that we know that demand still remains strong, but affordability remains an issue.
Nadia, when John read the opening quote from you, it said government policy and monetary policy.
Yes.
We've talked about government policy. Can you speak to monetary policy? What do you think will happen this year, and what do you think should happen this year?
So we think that you will get 2 rate cuts this year. Of course, a lot of this will be data dependent. And that pendulum, Mohamed, between this balancing act that the Fed has and the recalibration process, so that pendulum between, downside risk to the labor market and a potential upside risk to inflation is going to continue to swing back and forth to various degree. And right now, inflation is a concern. We're seeing tremendous progress in terms of on the labor market remain in solid progress on inflation. But the Fed, I think you want to see inflation come back under 2.5%. Core PCE is at 2.8%. And so if we can see progress that we're heading back under 2.5% on the way to the 2% goal, then that would be give the Fed some comfort in terms of continuing to cut rates. So we expect a pause in January. And also we know there's a changeover of the guard in the Fed, and the Fed is skewed a little bit more hawkish when you think about Muslim as well as, Schmidt coming on in terms of voters who tend to skew a bit more hawkish. And I think also the Fed is watching, policy coming out of Washington to determine policy.
And you're confident that 2 cuts is consistent with a confident path to 2% inflation?
We are. You can never be 100% confident right now because the data keeps changing. But we feel comfortable that 2 cuts this year will get us a pass. We expect core PCE to come back towards 2.5% by the time we get to mid-year. We've seen a pickup in inflation again. Some of this has to do with used cars, shelter, but we expect that to start to come down by the time we get to the spring and get to about 2.5%, and that would give the Fed some leeway to be able to cut.
Your long stocks. Let's finish on sector preferences. Where do you want to be right now? What do you like?
We continue to like tech. We continue to think that AI story is intact. News coming out of CES this past week has been quite encouraging. And we actually took up our CapEx numbers for tech for this year. We've taken it up to 25% growth, expecting $280 billion. And again, we think that those CapEx has room to grow even. The hyperscalers are spending quite a bit, but then the baton will get passed to enterprise as well as sovereigns, which we're watching closely just given all the talk around exports restrictions.
The numbers from Taiwan Semi, I think overnight, pretty decent,
yes,
right?
Very decent, 58%, year-over-year growth for December. That bodes well for the AI story.
Do you think investors will retain that patience in some of the likes of NVIDIA's biggest clients? It's been a big focus for us on this program. The capex spend has been huge. Do they need to demonstrate a bigger return on investment this year? Or do you think that patience will be maintained through 25?
You know, do you think that investors do want to see a little bit more in terms of monetization? And you are seeing signs of that already in terms of whether it be on the advertising side and so forth. So we do think that, you know, investors will be patient, but not too patient. We do want to see that gap between capex and monetization narrow, and we think that will narrow this year. But reality is a lot of this takes time to translate, and it could take another couple of years to sort of see that full, pickup in adoption.
Does that challenge the idea of a broadening out if basically the adoption isn't taking place and the big tech continues to be the winners in a sphere that's challenged by perennially high rates?
Not necessarily, because I think, you know, you can see areas, I mean, you look at financials, right, has been doing well, has given back some since election. But I think if the economy remains strong, if you're seeing a pickup in things like capital markets activity, if you're seeing a pickup in M&A, those areas of the markets that do well. And then also when you look at, you know, yes, you know, the manufacturing side has continued to be in a contraction territory, but new orders are starting to pick up. And so if that continues to happen, you can get some relief on the more cyclical areas of the economy, whether, you know, it be industrials and other areas like that. So we don't think that limits the broadening out. We don't expect the sort of same sort of exceptionalism from tech that you've seen last year. We expect it to outperform, but we think that other sectors can also perform well.
Nadia, appreciate your time. Good to see you, as always. Thank you. Nadia Lovell there of UBS. Looking ahead to next week, once we get through payrolls in just a moment, January 15th is a big one. Get CPI that morning at 8:30 Eastern time, and numbers from JP Morgan too.
Which is going to be more important? I was actually just thinking about that. At this point, with earnings coming out, I think that Delta is actually fascinating. Is this a demand supply story, or is this just the fact that people keep traveling because they have the money to do so, and really a consumer driven economy story? And we're going to be continuing to debate that as we get some of these numbers.
Numbers good from them. The stock is up big time in the pre-market. Up next on the programme, we'll be running through more estimates around payrolls and what's going on in fixed income. Before we get there, let's get you an update on stories elsewhere this morning. With your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. Nearly 200,000 Los Angeles residents have been forced to evacuate, with 5 wildfires continuing to burn throughout the city. Firefighters have made progress in containing some of the blazes. Accuweather estimates that the damage and economic losses could be as much as $150 billion. That would make it one of the most expensive natural disasters in modern American history. NVIDIA is criticizing President Biden on the new chip export restrictions that his administration is expected to soon announce. NVIDIA says that the White House is trying to undercut the incoming Trump administration by imposing last-minute rules. The AI darling says that the new rules will harm the U.S. economy and do nothing to promote national security. Elon Musk expressing doubts that his government efficiency task force can achieve $2 trillion in cuts to the federal budget. Musk says that he now thinks $1 trillion is more realistic of a goal, but even that would be challenging. The $2 trillion target would require significant cuts to popular programs like Social Security and Medicare, which is unlikely to happen. And that's your brief, John.
Danny, thank you. Appreciate it. Up next on the programme, we'll get you some morning calls. Plus, Mike Collins of PGIM, fixed income. As we count you down to December payrolls, Mike's thoughts on whether we're in the buy zone in this bond market. That's next. This is Bloomberg. Payrolls 15 minutes away. Equity futures into that negative by 0.2%. The estimate in our survey, the median, 165. Before we get to that number, let's get you some morning calls. First up, Piper Sandler upgrading Nike to overweight, expecting a return to profitable growth within the next year. That stock is up by 0.7%. Your second call from Needham upgrading Lululemon to buy, citing potential re-acceleration in US trends following a strong holiday season. That stock is up by 1.6%. And finally, MoffettNathanson downgrading Roku to sell. Analyst Michael Nathanson noting a competitive pricing environment and lack of M&A. That stock is down by a little more than 3%. Turning to the labour market, stocks and bonds retreating ahead of the December payrolls report coming in just a few minutes' time. Joining us now to discuss is Mike Collins of PGIM Fixed Income. Mike, Happy New Year to you, sir, and welcome to the programme. I want to start in your bond market. We've had the equity strategists come on and say the bond market's in the danger zone for risk assets. We want to know if it's in the buy zone for you.
Yeah, from a fixed income perspective, Jonathan, I think we are unequivocally in the buy zone, right? I mean, rates have backed up a lot, like you mentioned earlier, 100 basis points just since the Fed started cutting rates. That's historically a gigantic move. Right now, there's basically just about one Fed rate cut priced in over the next 10 years. All right. And could the Fed stop at 4% on the funds rate and keep it there for 10 years? I guess. But man, with the incipient nature of the weakening in the labor market, the preponderance of the data really seems to point to, a bias toward a chance that you're going to have much weaker than expected job market data or inflation data at some point over the next few months.
Mike, can you elaborate on that? Because what a lot of people think has changed over the past couple of months is exactly the opposite. That weakness in the labor market was viewed as something that was temporary. We actually saw a resurgence. Corporate profitability held up better than expected. And that is an ongoing story, as we saw this morning with Delta. I'm just wondering, what gives you confidence that the trend is weakening and not the opposite, some sort of resurgence in inflation?
Yeah, I mean, there's not a high level of confidence in any of these calls right now, Lisa. In fact, in our portfolios, we're just inching out into a longer duration position as we reach these new yield highs. But we've gone through this huge increase in jobs, almost historic level of increase in jobs lately. But you are seeing at the fringes, right, weakening leading indicators in the jobs market. And it just seems like the markets have fully priced in the continuation of this resilience you're talking about, the continuation of strong economic growth, of higher than expected inflation, of strong jobs data. And when that gets fully priced in, we just think the chance of a downside surprise is heightened here.
Mike, when people look at the attractiveness of fixed income, they tend to look at all-in yields. They tend to look at all-in U.S. yields dominated by treasuries, as you know, at the 10-year at 469. Suppose I took you away from that and say, comment on, would you buy here? Would you bet on corporate spreads? Would you bet on the UK? So take us away from how we sort of go in the summary statement and other elements of fixed income. What would you bet on when it comes to the other elements of fixed income?
I mean, that's a great point, Mohamed. The value right now, the long-term value in the fixed income markets, especially in the U.S. fixed income markets, I think is in the government bond component, right? The incremental yield you get or that excess spread you get in investment grade corporates, in high yield corporates, in other risk assets, even the multiples in the equity market I would put in the same category, are at risk. Right. I mean, and you're in a situation where if you get upside surprise in the data and rates jump again, that could continue to put pressure on fundamentals in corporate America, fundamentals in earnings. On the other hand, if you get a big downside surprise in growth or inflation, that starts to question the resilience of these profits and growth. So I really think risk assets, kind of like the Treasury market, are a little bit on a knife's edge here, could move in one direction or the other pretty quickly. But it seems like, again, the probabilities are starting to skew more toward rates falling and credit spreads presumably widening here.
And how bad can the widening be? Some people will say yes, but you're being compensated, so take that risk anyway. Where are you on this?
Yeah, I mean, the fundamental backdrop, Mohamed, is really solid. And we're seeing default rates, or at least our expectations of default rates in the high yield market, actually coming down. You've actually seen in the latest, quarterly earnings, the fundamentals in the high yield market, for example, continue to actually improve or remain really resilient. Companies, they're issuing a ton of debt, but it's almost all being used to refinance existing debt, to term out debt. So credit fundamentals, earnings fundamentals, are actually really solid in the credit markets. I look at the structured product markets. I mean, they're really solid backdrop for those markets. So I think any spread widening is a buying opportunity, and we're really light on credit risk right now in our portfolios, looking for opportunities to buy. Unfortunately, I think the whole market is set up that way. But I think that's the trade in credit is you play defense here, you wait for opportunities to buy. Remember, the technicals are great. As rates back up here, even though it does put fundamental pressure on companies because their interest expense will continue to go up, man, the technicals are great because companies will issue less debt as rates go up. And we are seeing kind of record demand from international buyers just in the last few days, Mohamed, into our credit markets here because the all-in yield is so attractive relative to, notwithstanding the UK, relative to almost any place else in the world. Look at, Chinese yields are falling, right? European yields, we have, our yields are twice the yields in Europe, or 4 times the yields in Japan. I mean, our market is really attractive from an international perspective in fixed income.
Mike, we're less than 8 minutes away from this jobs report, and you are setting it up with such drama that I absolutely love it. You're welcome anytime. Basically, are you saying that this could be a really significant move in the bond market across the board if we get some sort of downside surprise? Can you give us a sense of how, I don't want to say violent, but significant the move could be if we do get some sort of significant downside surprise?
I mean, you can get a big move either way. Like I said, the bond market is a little bit on a knife's edge here, right? I mean, the bond vigilantes, as we've seen in the UK, are at the ready to kind of hit the markets here if growth or inflation continue to go up, or the fiscal situation just continues to look really, really tenuous, as we've seen in the UK. So it could go either way. But again, with only one Fed rate cut basically priced in for the rest of our lives here, Lisa. I mean, wow, if you get weakness in jobs at some point in the next few months, and weakness in inflation at some point in the next few months, I mean, that one Fed rate cut could turn into 4 really quickly, right? So that's the kind of value, I think, that's in the bond market today. You could have a 50 basis point retracement in yields really quickly at some point in the next few months. So I just think that's where the skew is positioned right now.
Violent is exactly what Lisa wanted to say, Mike. Mike, appreciate your time as always. It's good to see you. Mike Collins of PGIM. It's what you wanted to say.
Okay, you just keep putting words in my mouth.
It's your word.
Well, it was significant. I don't want to make it sound violent has a negative connotation, but it could be really positive.
Let's put some Wall Street language on.
Okay, thank you.
I think a lot of guests believe that risks are skewed asymmetrically towards lower yields.
That's very diplomatic.
Because of what positioning looks like right now, right?
That's basically what he was saying, is that essentially one rate cut priced in for the remaining lifetime. I just think that his point, though, on the knife's edge is important, and that you could see a significant move in either direction is one that highlights the vulnerability and the volatility that's baked into this
Mohamed's
market.
warned about this a million times over the last several months. Credit to you. We are hypersensitive to incoming information. Whatever this number looks like in 5 minutes' time, we will build a massive narrative and extrapolate it out 12 months. And you'll see the market do the same, won't you? Almost immediately.
Yep, and then we'll remind ourselves that these are very noisy numbers and we shouldn't get carried away.
And then the Federal Reserve will respond to it at the end of this month and do what?
I have no idea. Good luck. I don't know. We're not sure.
Good news for them is that they don't have to put out forecasts,
That's true.
right?
Well, but this is part of the difficulty, right? We don't have a sense of their reaction function to incoming data. Is it just noisy? Is it something that indicates a real shift in narrative like we saw from September to December from the Federal Reserve?
And what's more important to them, today's report or January 20th? The first few steps that we get from the incoming president?
I actually think that for equity markets, it's actually incredibly important that we see a strong number. And that, I think, is going to be one of the more interesting surprises. Do we have an undermining of the American exceptionalism story if we get some weakness in this number that might be really wonderful for the Mike Collinses of the world, but maybe less so for some of the others? Michael
Hartner of Bank of America said a Goldilocks December report of 125 to 200 is needed to hold the 30-year yield below 5%. So we'll see.
125 to 200.
That's quite a range, isn't it? It's quite a range. Up next on the programme, it's the big one. Mohamed throwing shade at the south side. That will continue. The jobs number just around the corner. 165 is the median estimate. The number drops up next from New York. This is Bloomberg. It all comes down to this. You know how this works. The most important jobs number since the last one until the next one. The median estimate in our survey, 165. The previous number, 227. Equity futures into it, negative 0.2% on the S&P. On the Nasdaq, down by 0.3. In the bond market, your 10-year just about stable through this morning. Yields unchanged at 469. And the world in foreign exchange, watching what this number will be. With the number, let's cross over to Mike McKee. Good morning, Mike.
Good morning. Well, it looks like at this point you can turn your attention to CPI because the numbers come in pretty good for the Fed staying on hold. Change in non-farm payrolls, 256,000. That doesn't suggest that there's weakness in the economy, nor does the unemployment rate number, 3.9%. Or that's average hourly earnings. Excuse me. The unemployment rate number down to 4.1% from 4.2%. 3.9 would have been pretty amazing. But it is 3.9% for the year-over-year average hourly earnings, so 0.3 on the month, which is a little bit less than last month. So it looks like we're seeing a little bit less wage pressure. We're still seeing strong growth, and we're seeing an unemployment rate that is stable to falling a little bit, and that's going to keep the Fed pretty much on the sidelines for the coming month, I believe, unless we get some surprise next Wednesday.
Mike McKee, big move in the market. Let's get straight to it. Equity futures gapping lower. We're down by about 0.75% on the S&P 500. Push it through the bond market. Take a look at this. Up by about 9 basis points at the front end of the curve on a 2-year. On a 10-year, up by 8. We're approaching 480 at 477. I talked about what was happening abroad. We've got to look at foreign exchange worldwide. Everything weaker against the US dollar, including the euro and pound sterling. Cable down to 122, the euro back to 102.50. I had a quick look at the gilt market for you. I'm sure the Treasury of the UK is sitting there with its head in their hands. The 10-year in the UK up another 7 basis points to 4.88. Lisa, it's a big upside on payrolls in America.
Which is not certainly what the UK wanted to see, nor necessarily some of the officials in Germany and elsewhere. I do want to point out, though, for equity markets gapping lower, what I find interesting is this is actually a statement of strength when you take a look at private payrolls, which came in at 223,000, up from the estimate of 140,000. This is being driven by the private sector, and it's not necessarily being accompanied by major downward revisions. This is strength, and it really goes to the question of accelerating inflation and growth.
Getting closer and closer to 5% on a 30, on a 10-year, 476. The jobs number, if you missed it, comes in at 256. The median estimate was 165. The unemployment rate has come back down to 4.1%. We were looking for that to stick at 4.2%. And the obvious reaction in markets, bond yields higher, the dollar stronger, equities a little bit lower, down by 0.8%. Mohamed, you've had a few minutes to go through this. What do you think about this one?
I think this one's good for the economy. I know how the markets are reacting, but fundamentally, this is good for the economy. It confirms 2 things. One is the economy remains solid, and 2 is the U.S. continues to meaningfully outperform other advanced economies. And that theme of dispersion is going to become really important as we go forward.
How does this complicate the lives of people in the UK? And by people, I mean authorities in Europe, in Japan, who are just seeing repeatedly really strong numbers come out of the United States.
Yeah, I think they have to hope for something better, but recognize that they have domestic issues that get amplified in a meaningful way if yields continue to go up due to the US. What they cannot do is simply blame the US and stop there. They have actually got to get their own act together. And this is more about them than it is about the US. I know the US is leading the higher yields around the world, but when you expose people's weaknesses around the world, these need to be addressed.
The idea of the Draghi report, and I'm just looking right now at the euro, and it's dropping like a stone. Talk about parity. We're at 102.24, and this goes to this question of, do they get some sort of reform or energizing push into their tech sector, et cetera? The fact, again, I keep going back to this, and Mohamed, you're exactly right with the idea that this is unabashedly positive when it's being driven by the private sector. This is not government spending. So those discussions really have to change, which should be positive, maybe for the U.S., but the rest of the world.
I mean, the worst thing is to lose the only locomotive of global growth. If we lose this only locomotive of global growth, actually things get worse in the rest of the world. So the U.S. has to continue to be strong, but the rest of the world has to get its policy act together.
I believe Mike McKee is still with us, so let's cross back over to Mike and get a second look at these numbers. Mike, you've had about 4 or 5 minutes to pore over it. Big upside surprise. What's driving it?
A big upside surprise. It looks like we're getting numbers for things like retailers, manufacturing lost jobs 13,000. Construction was only up by 8. So an issue there. But the retail trade gains 43.4. So 43,400 jobs there. And of course, additional jobs in leisure and hospitality, of course. As always, healthcare up 69,500. That's kind of what we normally see. And leisure and hospitality up 43,000 in terms of that. Food services up by 30,000. So it continues the pattern that we've seen, but stronger for all of these things. Now, in terms of the unemployment rate, a big rise during the month in the establishment hiring. And remember, there were people who were worried about that last month, that they thought the establishment numbers were bad and therefore we were going to have a problem. But they go up by 240. The labor force goes up by 243,000, and the number of employed people in the household survey up by 478,000, while the unemployed number fell by 235,000. So more people joining the labor force, but more of them getting jobs. All in all, Mohamed is absolutely right. This is good news overall for the U.S. economy. And it will be very interesting to see, here's my one political comment for the day, how he will be President Trump, talks about the U.S. economy in his inaugural speech. Remember, last time it was American carnage. This is a long way from that.
Well, Mike, I'm sure he can turn around and say that some of these numbers, Lisa, are off the back of improved confidence from businesses to hire, going into what many people believe will be a pro-growth administration for the next 4 years.
I actually want to think less about the political spin on this, and I want to look more at just the actual numbers and just how sustainable they are. Does this call into question the fragility and the frozenness of a market that, as Mike just described, included more household survey hiring, lower actual people who are coming out of the labor market, and if you take a look at the participation rate staying pretty steady, even coming in. So to me, the underemployment rate's actually coming down, all pretty unabashedly positive.
5% watch on a 30-year. I know you're on 5% watch too. 498. 498 on 30s right now. The 2-year right now up 10, 11 basis points to 437. With us around the table is Stephanie Roth of Wolfe Research. Stephanie, good morning.
Good morning.
That's quite a number. What do you make of it?
Sure is. I mean, first of all, it's just quite a number, but average hourly earnings were 0.28. So this is kind of a Goldilocks type of report in a way. Of course, markets are trading it as a hawkish print. But the reality is that wages are growing at below 4%, even with job gains running this strong.
So we don't have to start talking about interest rate hikes anytime soon at the Federal Reserve?
I don't think we have to be talking about hikes, but we have to start thinking about when is the Fed going to be pausing. That's the real question.
Well, now, I think that's what people are saying, right? They're on pause, period. I think the question is just when are they going to revive? I want to go to the point that you're making about inflation, and that this does sort of question just how much inflationary pressure is under the hood of some of these gains. How accurate have the average hourly earnings actually been when it comes to inflationary pressures? Because ultimately, if people have jobs, they have been shown the willingness, particularly of millennials, in paying premium for premium seats on airplanes and other things. I mean, there still is the impetus to spend if you have a job.
Yeah, I mean, it all comes down to the labor market. If the labor market remains healthy, then people are going to go out and spend. The thing is that wage growth is still running, that 4%, which, given where productivity is, the Fed can kind of accept something like that. So, the Fed has said this a couple of times, that they don't believe that the labor market is really causing significant inflationary pressures. So now the question is just that can the Fed stay on pause from here, or can they cut one or two more times?
So Wednesday's ADP numbers on earnings showed a difference between 4% wage increases for those who are on the same job, 7% for those who are changing jobs. And the question becomes, if we continue to create so many jobs, if vacancies are already at a 6-month high, at what point do earnings become the lagging indicator? At what point do earnings respond to what's happening in terms of the quantity of jobs?
Yeah, and that's the trend that we saw, in 2022 and 2023, and the labor market started to heat up. There was that differentiation between job switchers and job stayers, and that is something to keep a close eye on. But as of now, the wage data have been fairly contained. And if we didn't see a wage price spiral in 2022 and 2023, it's very unlikely we'll see it this time around. That was the real strength in the labor market, and it didn't really unfold into something that was out of control, wage inflation. So this time I don't anticipate that will be the case. To get to your question earlier, how accurate is the wage data from month to month? Not great. This probably had some calendar effects that pushed down some of the data, But on a year-over-year basis, it's in line close to what the ECI is saying, which is kind of the gold standard anyway. So I would say, maybe it was artificially depressed by some of the calendar effects, but the reality is wage growth is running at something close to 4%, which is somewhat tolerable for the Fed.
So how confident can we be that we don't get the second round effect? Because some economists will tell you it's not surprising we didn't get in 2022, 2023, because people had no memory of inflation. So they didn't think that they needed to adjust. Now, 3 years later, people have a fresh memory of inflation. So can we be as confident that it's just a one-off? We don't get the anticipatory wage demands. We don't get the anticipatory price increases.
I mean, and that's going to be the challenge for the Fed, which is probably why they're going to have to sort of wait this out for a little while. And with tariffs, of course, that makes it a little bit more challenging. But I think at the end of the day, we'll see that the inflation is probably going to stay sticky somewhere between 2 and 2.5%. But I don't think we're risking 3, 4, 5% like we saw last time. So I think this challenges the narrative that inflation is going to easily get back down towards 2%. But something that we saw the last time has to be driven by supply chain issues, which we currently don't really have.
If you are just joining us, welcome to the programme. Just moments ago, a big upside surprise on a payrolls report coming in at 256, the estimate 165. Unemployment dropping back as well to 4.1% from 4.2. Off the back of that, some big moves in the bond market, particularly at the front end of the curve. The 2-year up by double digits. Off the back of that, as you might expect, some dollar strength. Euro dollar getting closer and closer to breaking 102. And if you check out the equity market, equity futures down across the board. On the S&P 500 down by 0.8. On the Russell, the small caps negative by 1.7%. We'll see if all of this sticks. We are on 5% watch on a 30-year yield. Lisa, the higher the session, 499.81.
And we're pushing back the potential for a first rate cut of 2025 from the Federal Reserve to, at one point, October. Now we're back to September, but really pushing it back. This is where we start to wonder, particularly in the small cap area, how much this becomes restrictive for a small subset of companies. And I think about housing, I think about mortgage rates, and how much that can remain dissonant from the rest of the strength from elsewhere before, it actually calls into question some of these dynamics.
Joining us now is Jeff Rosenberg of BlackRock. He's got thoughts on this market, I'm sure. Jeff, first of all to you, sir, and welcome to the programme. Your reaction to that number from 12 minutes ago?
Yeah, well, clearly it's a strong number, and that's the market reaction. That's the first point. Second thing is the retail component here. It's worth kind of like thinking about what's going on here. So it's having kind of an effect in two parts of the report. The retail numbers underlying are stronger because of the shift between November being negative because of the lateness of Thanksgiving and Black Friday. So you're seeing a little bit of a flattering on the headline number. The other thing is that average hourly earnings, which your last guest was talking about, which is kind of like it's maybe not so strong. We don't have to worry about inflation because it's, a weaker average hourly earnings print. You got to be careful. And the question was, how reliable is it? On these monthly payroll reports, the problem is the mix shift really can mess with that number. And the boost to retail this month may be factoring in. Those tend to be lower paying jobs. And so it may be actually understating the average hourly earnings, which if you didn't have that mix shift, this may actually be even a stronger picture, which is then the third point. This is just financial conditions tightening because it's less need for the Fed to cut. We priced out most of that. Most of that shift happened in the FOMC December meeting, but this is even further pushing it along the way. Now, Jonathan, you asked, does that mean, when do we start talking about the Fed having to hike rates? No. This is pricing out any need for the Fed to be cutting, and pushing on my longstanding, refrain every time I come on the show is just financial conditions are really undermining the Fed's view that their policy is really that tight. And so they don't need to be worried about how tight their policy is. And so this is pricing out some of those future cuts for 2025. Not that we had that many priced in to begin with.
Jeff, you've asked and answered most of the questions that we had. So I do want to go to this question of what do you do with this, right? I mean, does this make you more bearish on equities, or does it actually make you more bullish? Because ultimately you're not going to find the value in fixed income. It is going to come from the growth and the strength that we just saw reflected.
Yeah, and you touched on it as well. It's a good report, and Mohamed's first point was like, hey, this is good news. This is American exceptionalism. This is a strong economy. That should be good for stocks and risky assets. And I think that ultimately is the case. I think the market and the valuations have to get over the idea that you're facing some higher interest rates. I think from the fixed income lens, the higher interest rates are actually bringing relative value back to fixed income. We've really shifted the pricing of how much do we need the Fed to support. You talked in the earlier segment about the asymmetry. I very much agree with that the asymmetry is now kind of more in favor of fixed income in terms of how much more rates can go higher versus the potential for them to go lower. And we priced out a lot of that expectation of the support from the Fed. And I think that's helpful to the pricing of the bond market. And the kind of the sell-off that we're seeing here in the front end, leading, I think that has reinforced the attractiveness of yield in the front end of the yield curve.
Jeff, it seems that we're very comfortable with the notion that this pushes back whatever rate hikes, who rate cuts we're going to get, and we're going to get fewer, etc. But the minute someone mentions a rate hike, everybody gets really, really uncomfortable. Say, no, we're not there yet. What does it take to get there?
I think it takes a lot to get there. I mean, that's a very big swing. And obviously what it takes to get there, Mohamed, and you know this, is it's inflation. And not just like the somewhat unease of sticky inflation, but a complete change in the narrative that for all the forecasting of the underlying components and the imputed data and our understanding of inflation, that we've just gotten that so wrong, and there's a reacceleration in inflation. I think you have to have a reacceleration, not the slowing in the movement to 2% to shift the Fed and the market's expectation that this goes to tightening. I think it's a very high bar to get there, and we're really just pricing out the last few expected cuts in 2025.
Well, Jeff, let me put it another way then. How high is the bar to cut again, given what we've just seen over the past few months?
Yeah, I don't think the bar to cut again and to change the expectations on cutting is that high either. I mean, look at what we went through last year in terms of the swings in market expectations on what the Fed would do and the Fed's own forecasting on what it would do and the extreme data dependence here. So the bar to more cutting is we're seeing that stabilization in inflation. There's not the risk on inflation. And for whatever reason, obviously not the story today, you're seeing that slowdown that the Fed has feared in the labor markets. And a couple of data points on labor markets, again, not what we're seeing today, sub 100, pictures, increases in unemployment rates. You get two reports in a row of that. You could very quickly shift the narrative back to, the Fed's got to cut 2, maybe 3, because of this extreme data dependence that we have the Fed driving market expectations.
I see Stephanie Roth nodding along. I do want to just point out that briefly, the 30-year yield did hop above 5% before coming back down, but it's right now 4.9 up. There it is, 5%. Once again, you're shaking your head. Do you agree with what he's saying?
Yeah, I agree. The Fed's been data dependent, but very much on every data point, right? So to the extent that we have another couple of prints that are a little bit softer in the beginning part of, in the next couple of months, then the narrative could shift to some extent. We've seen every 3 months the market has been swinging from soft landing to hard landing to no landing, and realistically, you're probably somewhere in between. So base case at this point is the narrative is going to continue for a while. Then you're going to have the Q1 inflation seasonality problems again. So it's probably going to be towards the middle part of the year when we could start talking about potential cuts again.
So, Stephanie, you said the Fed is data dependent not only overall, but to every single data point, which, of course, Powell would push back on you and say, no. And that makes us all data dependent, right? And it makes us all add volatility to a market because we get swung around. Doesn't that bother you? Doesn't it bother you that everybody has become so data dependent?
It does. Nobody should be caring about the unemployment rate to 3 decimals and average hourly earnings to the same kind of thing. I just had that conversation with Tom Keene earlier. It makes us uncomfortable, but we all have to. We all are in this environment, even though they're trying to steer us away from that in theory. The Fed continues to get swung around by every data point, so then we all have to focus on the same thing and figure out every nuance within every single print. The retail thing is a good point in the sense that it was minus 29 last time, and now it's jumped back up 43. realistically, that drove some of the strength, and you probably should smooth that out. But we're in an environment that it's going to be tough. And by the way, next print, we're going to be impacted by all of the fires, and that's going to be a really messy data point as well.
Can you think of any Fed that got swung around as much as this Fed is getting swung around? I mean, I think back of the financial. I mean, I think back of so many bigger episodes.
Mohamed, I go post-pandemic. Post-pandemic, this Federal Reserve allowed the administration at the time to come out with huge fiscal plans in a supply-constrained economy and just say, we'll look through it. We'll look through it. They weren't data dependent then. They waited. The change in behavior on the FOMC, I hear a lot of economists, present company excluded, a lot of economists who are more keen to defend the institution than provide critical analysis of it. That's really problematic for me, for economists on Wall Street who are hell-bent on making sure that their friends at the FOMC still give them access to have conversations at NABE, etc., than actually just calling things out for the way they see it. This Federal Reserve has behaved very differently under Biden and has changed when Donald Trump has come into power. They've opened the door to those accusations themselves with that news conference back in December. Without a doubt, do you agree?
No, I agree that now we have a Fed that's navigating two things: the monetary policy landscape and the political landscape. It's not navigating one thing anymore. It's navigating two things, and we just have to keep that in mind.
Why wasn't it navigating the political landscape 2-3 years ago, when it was clear that fiscal policy was in the driving seat?
I think 2 or 3 years ago, they were asleep. And the rush to call inflation transitory, ignoring the policy side, ignoring all the uncertainty, was a big mistake. And because of that, they became extremely data dependent. And they don't even want to look forward anymore. And it's ironic because we're dealing with markets that are supposed to be looking forward. We're supposed to be discounting the future, right? And yet we've all become completely dependent on what's just happened. It's absurd. But that is what happens when the institution with the printing press in the basement decides that it will become excessively data dependent. It turns us all into extreme data dependency.
They meet again at the end of this month. We'll get 2 more data points before then. CPI is one, the inauguration is another. What's this news conference, this meeting rather, going to look like at the end of this month?
Yeah, I mean, I think we're gonna. Well, let's first talk about maybe CPI because that we're looking for something that should be a little bit more soft, something like 0.24% on core, which should be okay. I don't think it's going to change anybody's view, especially after this print. This print made the CPI a lot less important. And then we're going to have to see from the Trump administration what's going to happen in terms of immigration. That's going to be one of the biggest things that's going to happen probably right off the bat. How aggressive are they going to go? It's probably going to be at a lot of I'll bark at the beginning, and then realistically we're not going to see that much deportations because that's going to require funding that they don't have, and it's probably just going to be people rolling off the humanitarian parole and TPC. But that's going to be a big thing to watch out for. And then the second is what's going to happen from a tariff perspective. We haven't really heard much specifics, rewinding back to the announcement on Canada and Mexico. Are we going to get more of that? Probably not. We're not hearing much of it. But those are the two things we're looking out for most from him. Tariffs and what we're hearing from an immigration perspective.
Jeff, as an investor who has to take a longer-term view, how do you remain independent from this excessive data dependence that we were just talking about? How do you have any conviction with calls at a time where people are talking about how much the parameters could change based on whether it's CPI or whether it's January 20th in the inauguration?
Yeah, it's really recognizing, the things that you think you can forecast and recognizing the things that are just not forecastable. And we have a little saying, if you can't forecast, and I would put all of the policy uncertainties that were just described in that category, then you have to observe. And so you just kind of know what you can kind of control and know what you can't control, know what you can forecast, know what you can't forecast. Try not to overreact to every data point. But on the fiscal policy, I mean, that is basically the story for the 2025 outlooks is uncertainty and unforecastability. So we're going to have to kind of recognize that, and we're going to sit back, we're going to be patient, we're going to observe. And then, as the information becomes more clear, that's when you can take action in your portfolios. To try to do it ahead of time, I think you just have to recognize that's a very difficult exercise, both forecasting what is going to be the policy and equally forecasting what is going to be the market reaction to that. Getting both of those right is very unlikely, so you're going to have to sit back and wait for the data to reveal itself.
Hey, Jeff, appreciate your time, sir. As always, Jeff Rosenberg there of BlackRock. We'll take a step back and a big deep breath and look ahead to CPI next Wednesday as well, and some bank earnings too. Mohamed, just a final thought around the table. We came into 25 thinking about US exceptionalism and global divergence. And Lisa and I have been talking about this for a number of days now, a number of weeks. The extent to which we can keep stretching that rubber band, how far can we take that? How much oxygen is left in that story before we get these negative feedback loops and things start to move in the other direction?
I mean, that's a great question, and I'm not sure I can answer that, but I can tell you that the theme of dispersion is really important because there's a limit to how long you can run a system with significant dispersion. And we have two main dispersion issues, US vis-a-vis the rest of the world. The hope is the rest of the world comes up to the US. The fear is the rest of the world drags the US down. And then within our economy, low income versus the rest. Low income they're struggling right now. We must not forget that. And these numbers cannot make us not also consider what's happening at that end, because at some point that we can migrate up. So the theme we're going to be talking about a lot is forget about averages, look at sectors. And that in the marketplace, we've gone from a market focus to a theme focus, and now it's going to all be about individual names.
Honestly, I'm just looking right now at the euro, touching the weakest since 2022. Yeah. My question is, strong dollar, how much does it actually start to impede earnings from U.S. companies?
Sets up a big week next week. Stephanie, it's good to see you.
Good to see you.
Mohamed, a special thank you to you. Thank you very much. As we count you down to the opening bell, we're already looking forward to Monday. Coming up on Monday, the lineup looks like this. Neela Richardson of ADP, Chris Harvey of Wells Fargo, Michelle Meyer of MasterCard, and Veronica Clark of Citi. From New York, thank you for choosing Bloomberg TV.